Good morning. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brooke DePalma, and we have March inflation data more benign than estimated. Month over month, consumer price index rising by just 0.1%. That is the headline number, excluding food and energy, in line with estimates, with a gain of 0.4%. The year-over-year gain in headline CPI 5%, and excluding food and energy 5.6%. But I think the takeaway here is that month-over-month increase on the headline basis, just 0.1%. That's half what's estimated, and is a dramatic deceleration from the 0.4% that was recorded in the month of February. A lot of that, in advance of this, economists were anticipating that there would be a slowdown in energy prices and gasoline and fuel, and that would help that headline number. Indeed, when you back it out, you don't see that same kind of, you just see 0.1% deceleration in the month-over-month rise in inflation. So interesting there, guys, as we start to dig into these numbers.
Yeah, and even some of the categories that we were looking at there, and consumers may look at this and think, okay, the importance of this report, number one, of course, what the Fed will do with this data here and what they're going to ingest and kind of extrapolate from this report, because coming into this, FedWatch, FOMC FedWatcher, the CME tool, was already pointing towards a 73% chance or probability that they were going to issue a 25 basis point rate hike at their next meeting. But on the consumption front, at least here and now, today, for consumers looking through everything from the new vehicles and used cars and trucks, that is one area that we've actually been keeping an eye on over the course of this week, given some of the earnings reports that have come out and even some of the research reports, giving us a little bit more inclination around where some of that price is beginning to moderate and where volumes actually are maintaining. Used cars and trucks, I actually saw that come down by about 0.9%, and then over the 12 months came down by about 11.2% for that year-over-year gauge there as well.
Yeah, just quickly wanted to mention what's going on with the markets in terms of reaction to this, or lack of reaction to this, because we are not seeing a huge move in the wake of these numbers here. If I take a look at the futures and you see there the movement, we're seeing a little bit of a movement, actually a push upward here. So it does look like we're seeing a little bit of a positive momentum and futures coming from little changed in the wake of these numbers, and now actually seeing a bit of a bump here. So we're going to be watching that. We're going to be watching what happens with yields today as well. And Brooke, I know you're looking at all the food components of this.
Well, some really good news for consumers here. Food at home, groceries essentially down 0.2% compared to last month. This is the first decrease that we've seen in quite some time as that food inflation continued to persist. Year over year, though, the number is still high, up 8.4%. But compared to last month, these are good numbers here and definitely show some relief. We're still seeing some persistent in eggflation, as you could say, month over month up 36%, but year over month over month up year over year up 36%, but down 10.9% month over month here. And in addition to that, we're seeing year over year dairy drop 1.3%, year over year lettuce prices drop 5.6%, tomatoes also down 3.4%. A lot of those produce, they are affected by California's wet weather. They had severe weather in March, and so some surprising numbers there as well.
Yeah, I also wanted to mention what's happening with shelter, because this is an area that the Fed has really been focused on here. So if you look at shelter overall, it saw a 0.6% gain month over month, which again is a bit of a deceleration, but a small one, right? Just 0.1% slower than it was the month before in terms of the increase that we're seeing. That's really where the Fed's going to be looking to that and to services inflation as well, to see if there is more moderation. In other words, yeah, it's great. The gasoline prices are mitigating, but A, they could go back up again. And B, that's not what the Fed is really focusing on.
Yeah, and within that services figure, transportation services, that continues to remain, at least on a year-over-year basis, one of the more outsized moves to the upside. In fact, the most outsized move to the upside year-over-year, 13.9% increase on the 12-month scale there. And then some moderation still month-over-month there, moving higher by about 1.4%. But then there's one other type of service or care that is important for us to think about, which is medical care. And even as we're going to continue to have the discussions around where there is so much importance for driving down some of the costs for medical care commodities, that continues to remain elevated year over year, up by about 3.6%. Not the biggest gainer, but of course still a very important one for everyone at home.
So overall, Inflation decelerating a little bit, a little soupçon of disinflation here on the month, and stocks higher. We'll have much more. Be right back here in 25 minutes.
Twitter no longer exists, at least as a standalone company here, technically speaking. The Elon Musk-owned social network is merging with a new shell company called X Corp. That's according to a California court document from a lawsuit filed against the company and its former CEO Jack Dorsey by conservative activist Laura Loomer. Now, Musk first hinted at what he called X, the Everything app, last fall, before his purchase of Twitter was finalized, likening the idea to something resembling the Chinese app WeChat, which is used in a number of capacities, including messaging, payments, and booking tickets. The move has sparked considerable speculation online about what is next for the platform, and though Tesla CEO has been pretty vague about specifics, he did tweet out X very early this morning, which has since garnered nearly 30 million views. Well, speaking of Elon Musk, let's talk about Tesla. Shares moving to the upside today, up just about 2% with about 40 minutes to go until the closing bell. The EV giant announcing this week that it's building a Megapack battery factory in Shanghai, China. But what does this all mean for Tesla's broader expansion plans? Joining me now, Dan Ives is here in studio, Wedbush Managing Director and Senior Equity Analyst. We've also got our autos reporter, Pras Subramanian, here at the desk with us. Dan, what do you just give us a sense of how significant this is and why specifically Shanghai, do you think?
Well, I mean, the hearts and lungs of Tesla are in China. And regardless of all the talk out there, I mean, they're doubling down on China in terms of this battery factory. And you look at what they've done in terms of just manufacturing. I mean, China, not just from a supply, but demand perspective, that continues to be one of the key ingredients for success. I think that was almost a flex the muscles moment in terms of what you saw here.
So I think it makes sense for them to build these battery packs in China where the materials are, the expertise is, you can build them cheaply. Do you think Tesla can kind of shake off the governmental sort of overreach there? Can they kind of, have them ignore that and still kind of perform there? Or is it going to be a overhang for the company as Washington kind of gears up against China?
Sure, it's great. I mean, with Big Brother watching in Beijing, I mean, look, that's the tightrope that both Musk as well as Cook walk in terms of what we've seen. I mean, that's where production for iPhone as well as a lot of the Model 3 and Model Ys are. Look, I think ultimately, they'll start to build out in the U.S., but I think this is a signal, and I expect Musk to also be spending some more time in China, that's one of their core advantages in terms of what you see with the Gigafactory there. And you look at batteries, I mean, that is really going to be the sort of the golden goose in terms of going forward.
Dan, you mentioned maybe we could see more plants, more factories here within the U.S. Musk has a goal of 20 million vehicles to be produced by the year 2030. If that goal is going to be achieved, how many plants do you think could potentially be necessary?
Look, I think it's first thing first, right? Making sure they don't trip over their shoelace. I mean, especially right now, they're cutting prices. Demand's been strong, but I mean, that's a balance, especially with the price war in China. But you see in terms of Mexico, I think Indonesia's next. You're going to continue to see more and more factories out there, but that's going to require CapEx. And I think it's also important right now that if you look at what's happening in Europe, you look at Austin, I think those are the keys in terms of Berlin as well as Austin, ramping those. And of course, in longer term, there's going to be a lot more things behind that.
Do you think Canada is the most likely destination, given the IRA sort of influence there?
I think it checks every box. And I think when you look at Canada, you look at Indonesia, those are the ones that make the most sense. And then of course they'll continue to expand. I think for right now, I think you take a step back, it is really the scale and scope. I mean, you look at a lot of the other, whether it's Lucid, whether it's some of the 313 area code, GM, Ford, a lot easier said than done. I think right now, that's why they're trying to put an iron fence around their backyard.
What about Mexico, the new plant that they announced there that is located there? How critical is that just in terms of Tesla diversifying its supply chain and really getting ahead of any potential types of issues?
Well, also it's about a sub $30,000 car. I mean, you're not getting a sub 30K car if that's being built in Europe or Austin. And I think it's sort of carrot and the stick. That's what everyone's waiting for here. But because to get to, as you talk about, some of the longer term goals, you need to be mass market, you need to be sub 30,000. But then I think the big debate going to next week is margins. Like, what do margins look like? We believe at least this quarter they'll be able to sort of toe the line in the sand. But if you continue to get significant price cuts, look, that's the work. Look, I think we're going to get more price cuts. I think they're containable. But I think, especially in China, that's really right now the biggest variable. They've been able to navigate, I think, extremely well. That's why the stock's done what it's done. But I think that continues to really be navigating this next step is what investors are focused on.
So do you think these sort of 5 price cuts this year alone, is that really indicative of a demand problem? Or is it more about them sort of going after competition like GM and Ford and just sort of growing the market share?
Look, I think it's a softer macro, and I think we saw that last year. So you got to just read the room, rip the Band-Aid off, and that's what they've done. So I think the first step has been what I view as just a massive poker move that's paid off. But it's competition. Whether it's 313 area code, whether it's Europe, you got Lucid, you got everyone coming. They can't just sit there high in their chair and not cutting prices. And I think that's essentially what's happening now. But because of the margins, they have that flexibility. Look, the haters are going to continue to hate on Tesla no matter what they do. So far this year, it's been a massive bet. Next week's important just in terms of that margin story. That's really going to be the front and center.
Dan, how worried should Tesla be about competitors? Obviously, it probably has something to do with the price cuts, but just given the number of EV models, new EV models that have either been brought to market already or with plans to come to market, a number were on display at the New York Auto Show this year. How big of a threat do you see some of those models being specifically to Tesla?
Yeah, I mean, it's still Tesla's world, everyone else paying rent in terms of EV landscape. But in terms of everything Mary and the team are doing, GM, I think that's probably the one that could have the biggest ripple effect. And that's competitively speaking, but you got lower price cars. You look at what's happening on the Cadillac, you got a lot of the models coming out, over the coming years. I think that's the broader thing is that you have what I'll call an EV arms race going on, but I do not view it as a zero-sum game. I mean, I view this as it's a green tidal wave, the biggest transformation to the auto industry since 1950s. But at the top of that mountain is Musk and Tesla, and everyone's trying to play catch up.
So far, really, Tesla's the only kind of EV maker at scale, right, across the globe. We talked about GM and Ford earlier today in the green room. They're coming on strong, new competition. Are there any sort of potential hiccups for them trying to get to scale? Like, I feel like that is a very difficult thing for any automaker, let alone legacy, to get to that EV scale.
Well, and also it's easier when Tesla's doing it under a different magnascope and microphone, because you look what's happened with GM, maniacal focus by the street in terms of margins, but yet Tesla was held to a different standard because of credit. So I do believe it's an apples to oranges comparison. I think GM, I think what Farley and Ford are doing are, I think, great steps. but easier said than done in terms of that scale, production, battery. But I do believe we sit here 2-3 years from now, I think GM could be a double, in my opinion, as they get ultimately find success converting to that massive EV base. And that, along with Tesla and some of the pure plays like Lucid, you look at NIO, XPeng, and some others in China, there's not just one way to play it. Tesla continues to be our favorite play.
Certainly expecting massive growth there across the industry over the next several years. Dan, it's always great to have you here in studio. And of course, our thanks to Pras as well.
The Federal Reserve finds itself in an increasingly tough environment as it looks to fight inflation, navigate slowing job growth, and preserve overall financial stability. The March jobs report offered the latest glimpse into the state of the labor market, while traders are anxiously awaiting tomorrow's inflation data for more clues on the Federal Reserve's path ahead. Let's get over to Yahoo Finance's Jennifer Schonberger. She's sitting down for an exclusive interview with the New York Federal Reserve President, John Williams. Jen, take it away.
Good morning. I am indeed here live at the New York Federal Reserve with the president of the New York Fed and vice chair of the Federal Open Market Committee, John Williams. President Williams, thank you so much for sitting down with me and for having me here at the New York Fed.
Well, it's great to be here and welcome here to the bank.
Thank you so much. I want to kick off the conversation with your reaction to the March jobs report. We saw the non-farm payroll number cool off a bit from those blowout numbers back in January and February. At the same time, temp temp jobs went down by 11,000, and job openings have fallen to the lowest level in 2 years. While still strong, does it give you any assurance that the job market is starting to come back into balance?
Well, we definitely see some slowing in the demand for labor, as you just pointed out. Job openings have come down gradually, but they're very high still relative to history. Unemployment, of course, is very low at 3.5%, and job growth is still quite strong. And in fact, when you look closely at the data from the past few months, we had unusual weather patterns, and I guess when I look at that, it seems like job growth is actually quite strong still, even in the latest data. So yes, we are seeing some slowing in the demand for labor, but the demand for labor is still very strong. Labor market is still very strong.
How much do you think of this as structural, given some of the trends we've seen from the pandemic?
Well, I think some of it I think is still related to the pandemic, and the labor market and the economy have had to adjust to the shifts in demand and supply that we've seen over the last few years. And I would add to that Russia's war in Ukraine. So a lot of factors have affected the U.S. economy and the labor market. In terms of structural, I think one of the things we are still watching for is a lot of people who retired earlier than usual. Will they come back into the labor force, or is there some change in their decisions that they've made going forward? Other than that, I don't really see that this is really fundamentally being structural, but more just a reflection of the highly unusual patterns we've seen in the economy the last couple of years.
So then, given your assessment of the job market and new developments we've seen with OPEC cutting back on oil production, how does that inform your outlook for inflation?
Well, inflation has started to come down. It peaked for the last year around 7% on the personal consumption expenditures price index that we follow at the Fed. It's down to about 5%, still way above our 2% goal. We're seeing inflation come down mostly now in the commodities and the goods prices, and I think that does reflect some of the pandemic effects, fading. We're seeing supply chains opening up much more globally, so those things are all good to bring down those factors of inflation. We're also seeing some signs that demand for housing is slowing. We're seeing that in the housing data. We're also seeing that in the rent data for the new, rents that people are signing new their new leases on. So we're seeing signs of inflation slowing, but inflation is still very high. And I would just mention that, some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
So you've got inflation risk. On the other side, there's still reverberations now from the bank failures last month. So what are you seeing in terms of credit conditions? Any sense of whether credit conditions have tightened further since those bank failures, and whether banks are cutting back or may soon cut back on lending?
Well, this is something I and many others are watching very closely. Right now it's still pretty early days in terms of seeing clear signs of changes in credit conditions and credit availability. I'll be watching that closely to see those signs, and then see any broader effects on consumer spending, business spending, and other parts of our economy. So right now, you're not seeing any strong signs of those effects happening, but it's something I'm very much watching for. I would say it's in the context of an economy that's actually growing pretty well. First quarter growth, it's not, we don't have the official numbers, but it looks like the first quarter growth is well above 2% at an annual rate. Labor market, as we've talked about, is still growing, is still very strong. So we're starting from a place of a pretty strong beginning to the year. It's just a question of, do credit conditions tighten somewhat, and how much of an effect does that have on the outlook? Still a little uncertain.
So given that, how do you view financial conditions now?
Yeah. So, I think it's important to separate some of the credit availability from banks, because the issues we've seen are really in a few banks from broader financial conditions. I mean, we've seen financial conditions tighten since the Fed has been tightening monetary policy. And I would highlight that central banks around the world have been tightening monetary policy. So I think that financial conditions broadly have tightened in the way you'd pretty much expect, given monetary policy moving from very accommodative to now somewhat restrictive.
So then, given that, how does that inform your thinking for the policy path and ultimately the peak on the Fed funds rate?
Well, so right now, I think we've gotten monetary policy into a restrictive stance. Underlying inflation is probably in the low 4%. Obviously, we raised the target Fed funds range above that. I think the question for us is to really watch the data. We got a lot of data coming, obviously, on the retail sales and CPI and a lot of other indicators, and see what are we seeing in terms of the trends in demand, both in the economy and in the labor market, and what we're seeing in the inflation data. I go back to our economic projections in March. Clearly, if you look at the median dot, if you will, people expect maybe one more rate increase. I think depending on conditions, we'll see what we need to do. I think really it's going to be a period of also just learning along the way. Are we really getting to the sufficiently restrictive policy to make sure that we bring inflation down to 2%? We need to get that done in the next couple of years, so we need to get policy right for that.
How restrictive would you say we are right now?
Well, I would say we're somewhat restrictive. I mean, I would get out my thesaurus maybe and come up with a more creative word, but I think somewhat restrictive. My view of kind of the longer run neutral real interest rate is about 0.5 percentage point. So I think we're somewhat above that. So the real question to me is, we've gotten to restrictive. What's it going to take to be sufficiently restrictive? Do we need to do somewhat more to get there? And obviously be driven by kind of the data and the outlook.
Did your estimate for the peak on the Fed funds rate change at all given the bank failures?
Well, I think that we all have to take into account a lot of different factors in thinking about the economic outlook and the risks of the outlook. And we've seen the data, come in pretty consistently strong. At the same time, and inflation has been very high. At the same time, I think the economy is going to grow at a pretty modest rate this year. That hasn't fundamentally changed. So I do think that the bank failures add to uncertainty about the outlook, and we'll have to take what actually happens into account. But fundamentally, my view is we have an economy that will grow modestly this year. Unemployment will probably edge up over the next year somewhat. Inflation will come down.
Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing that you need to know, inflation is decelerating but still remains high. The Consumer Price Index showing a rise of 0.1% month over month. Economists were expecting CPI to rise by 0.2%. The data excluding food and energy that came in line with expectations at 0.4%. Shelter is also showing signs of slowing, which is something economists were closely watching. Second thing you need to know. So headline inflation showing signs of cooling, but will it be enough to change the Fed's trajectory ahead of that May meeting? The central bank will be looking for signs price pressures are still sticky ahead of that key date, and they probably have it in a stubbornly high core inflation figure that might be enough reason to push back on all that rate cut talk. Third thing that you need to know this morning. We're going to take a pulse of the U.S. economy and the financial system with two influential voices. IBM Vice Chair and former Chief White House Economic Advisor Gary Cohn joins us to talk monetary policy and the fallout from SVB's collapse. The last time the United States and a banking crisis collided there, he was the second in command over at Goldman Sachs. We're also going to talk storm clouds with Dr. Doom himself, Nouriel Roubini. He's known for predicting the credit crash of 2007, and in his more recent warnings, says the U.S. is heading for a stagflationary debt crisis. Julie?
Let's get more details now on this morning's CPI data. Look at the categories to watch, some of the components where the increases were coming from. So let's start with food inflation here. We did see slight month-over-month increases in some categories like cereals and bakery products, non-alcoholic beverages. You did see month-over-month decreases in areas like meat, poultry, fish, and eggs. I know eggs have been under a lot of scrutiny. They saw a big month-over-month drop, although a increase year over year. Dairy and related products, fruits and vegetables. So a lot of the stuff that you are finding in the grocery aisle, even though it is still in some cases more expensive than a year earlier, it is falling month over month. If you look at the year over year figures in comparison here to kind of let you know the differences, there you see year over year increases across the board. So what we are focusing on and what the Fed has been focusing on is either an outright drop in prices month over month or what we're calling disinflation, a smaller rate of increase. They're not focused on food so much, though, are they? They're focused on things like shelter inflation. And we did see a decrease in the rate of change here. Still on the rise, 0.6%. But this compares with the 0.8% increase that we saw in February. And then we saw some 0.7% increase month over month for the couple of months before that. Year over year, still up 8.2%. So this is still something that the Fed wants to address. We do know that housing prices do operate with more of a lag to the overall economy. The good news is on the inflation front, we did see some relief when it comes to transportation. Used cars and gasoline both seeing declines in March. Gasoline down 4.6% month over month. Used cars and trucks continuing the downward trend, 0.9%. And if you look at the year over year numbers here as well, you do see a big declines. One thing to note here, where you're talking about used cars and trucks, as I said, that's more of the trend. But when it comes to gasoline, of course, it is quite volatile. And some economists are saying we could see a bounce back from this big trough in prices. And anyway, the Fed doesn't watch it, but it does feed through to more sticky prices for other stuff. Brad.
That's right. Well, for more on this, economists have been closely watching for March's inflation report for clues on what the Fed's next move is. Let's dive into it with Yahoo Finance's Jennifer Schoenberger here, live and living color on set with us. Jennifer.
Good morning, Brad. It's great to be with you guys in studio.
Absolutely.
I got to tell you, I thought that inflation report was still a bit sticky. If you look, yes, month over month, it came down a bit, but year over year on that core number, which is what the Fed really zeroes in on, excluding those volatile food and energy prices, it was still stuck at 5.6%, well above the Fed's 2% target on inflation. And yesterday, I spoke with New York Fed President John Williams, who says inflation still remains too high and that the Fed still has a lot of work to do. And this report seems to be in line with that. Take a listen to what he told me yesterday.
But inflation is still very high, and I would just mention that, some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
He said one additional rate hike is still the starting point for mapping out policy right now, and that he remains open to either raising rates again in May or possibly waiting until the summer, depending on the data. When I asked him whether he'd be open to resuming rate hikes after pausing if inflation remained too high, he told me absolutely.
And of course, he was the only one who spoke exclusively with you, Jen, but we did hear publicly from some other Fed speakers as well. One of those who stood out to me was Austin Goolsbee, the new kid on the block when it comes to members of the Fed. And there was some interesting commentary.
Yeah, he seems to be a little bit more dovish. He's very focused on the potential reverberations from the bank failures that we've seen and the potential for credit tightening there. And he thinks that the Fed should be cautious here and really gather data, maybe take a step back. On the flip side, we also heard from Minneapolis Fed President Neel Kashkari last night at a town hall. And he says, yes, the Fed's rate hikes and the reverberations from these bank failures increase the odds of a recession. However, the failure to bring inflation down could be worse and could hurt the job market. And he was talking to students in Montana State University, and he says if we fail to bring inflation down, your job prospects are going to be worse. So Kashkari still very much in that hawkish camp. Woo. So diversity of views here.
Yeah, I'm sure the students love to hear that kind of commentary. But the Fed's on the case, I guess, is what the message he was communicating. Right. Jen Schomburger, great to see you in studio.
Thank you.
Thanks for being here. All right, let's talk more about what the CPI data means for the larger market. Will Compernol is joining us now, FHN Financial Macro Strategist. Will, how are you viewing the data that we got this morning, and what does it tell us about how sticky inflation is at this point?
Well, good morning. Thanks for having me. I think the kind of disappointing answer to what does this inflation report show is that there's nothing new. It's really a repeat from the last few months, which is that core services ex shelter, what the Fed likes to call its super core inflation, when all of the noise from supply chains normalizing and food and energy kind of zero out what they consider underlying inflation, the momentum is still too high. And so that is how the Fed is viewing inflation. Now, just to put into a larger context, that headline inflation going down from 6% to 5% year on year, it's important to remember that that is compared to March of last year. So that's right when global commodity prices spiked following the Russian invasion of Ukraine, which means that that spike is essentially priced out of year-over-year comparisons, the so-called base effect. So it looks good. It's a percentage point improvement. But really what the Fed is looking at is the momentum. And when you look at month-over-month momentum of the super core, the three-month change annualized, then it's too sticky. So I think, when we look at expectations for the May meeting and onward, this CPI report might really not add too much. I think the PCE inflation data, which comes out, I believe, April 28th, a few days before the FOMC meeting, that will really set the tone. Of course, even later today, we get the FOMC minutes, we get retail sales spending, retail sales on Friday. So there's a lot more potential to shift expectations after this report.
I've been kind of trying to get a pulse on how many months makes a trend for the Fed here, and when that kind of puts us in, at least on this kind of calendar year basis, when that puts us within the throes of them having a conversation about any type of pause or even a pivot if the data continues to come in suggesting that things are slowing.
Well, I think the Fed right now is really operating from a point where they want to not repeat the mistakes of the late 70s, early 80s, where monetary policy kind of eased up on tightening a little prematurely. And it meant that they had to inflict more pain through more aggressive interest rate hikes and not really going back to square one, but certainly they kind of increased the work they had cut out for them. So I think the burden of proof is really on inflation slowing down. So you can kind of nitpick and look at the nuances of any inflation data to say, well, things are improving. But there are two things to keep in mind. The first is an improvement from the highest inflation in 40 years is still too high. So we've got to get monthly increases back to 0.2%. That's consistent with the Fed's longer term 2% year on year inflation the kind of persistence of those improvements really needs to convince the Fed that these aren't kind of one-off blips, because there's a lot of noise in the economy right now, as there has been in the last few years. So, I think to answer your question, there's not really a certain number of months that dictate a trend, but inflation is still too high, even when we can look at certain aspects that are improving.
So all of that paints a pretty uncertain picture, continuing, Will. So what do you do from a strategy point of view, given all of the unknowns?
Well, I think, let's go back to the Fed's March meeting. So in Chair Powell's press conference, what he said in so many words was that built into the Fed's 5.125% end 2023 dot for the projections for Fed funds was an assumption of some credit tightening from kind of the bank tensions that we've seen over the last couple months, or I guess now month. So that is really the important thing that the Fed is watching. And I think that's going to play out not over the next few weeks before the May meeting, but over the next few months. So in that sense, the May meeting could have a 25 basis point hike if inflation really is unambiguously kind of driving the Fed to prioritize that. But really, there will be more clarity, I think, by the June meeting, where we'll have, first quarter bank earnings calls in our pocket to really see how banks have adapted to this atmosphere. We'll have a few more months of spending and inflation data to see to what extent the economy may be overheating. So, the real answer is that in the next month, I think we still are seeing a lot of uncertainty. And hopefully by the summer, things will be a little bit more clear.
So since you mentioned the banks, and as we kick off the earnings season and are expecting to hear from the large banks and then start to get into some of the more perhaps impacted or at least sitting on the edge of their chairs, regional banks as well right now, what do you believe in the tenor that we hear from them the Fed could or should pay closest attention to, even despite us knowing that the Fed looks at the economic data, looks at some of the lagging data? There have been calls for the Fed to look at or at least consider more forward-looking data. So what is it that they can pay attention to with some of those banks?
I think it's a really tough call. The monetary policy famously operates with a long and variable lag when it comes to inflation. But I think evaluating tightening financial conditions, what it means for bank credit is even more of a moving target. So I think they're going to rely on their bank contacts. Remember that these 12 regional Fed banks are really in close contact with local banks that are, deciding whether to tighten financial conditions. Now, I think that will be more of kind of a harbinger than the actual data, because even when banks decide, okay, we're going to kind of increase lending standards, we're gonna cut back on some loans. Well, that happens with its own lagged impact, and then of course, when that shows up, it's reported with a lag in the data. So I think the Fed is really going to lean on its bank contacts to see, do they need to pause in May because credit is contracting too much, or can they kind of incrementally go about fighting inflation?
Will Compernol, who is the FHN Financial Macro Strategist. Thanks so much for joining us here this morning.
Thank you.
Absolutely. Well, on the heels of the CPI data out this morning, some big names are joining us to put the latest numbers in context and tell us what can we expect from the markets in April and beyond. First up, an outlook on global banking with Gary Cohn, the former NEC director, the National Economic Council there. That former director is going to tell us what's to come after March's rough banking run, our new regulations in our future here. And then next up, what's Washington thinking for inflation? We're joined by Heather Boushey, who is the White House Council of Economic Advisors, with the latest reactions from the Biden administration. And then in our 11 a.m. hour, we're visited by the aforementioned Dr. Doom. Nouriel Roubini, the government name there, NYU Stern professor, says that we should brace for a brutal financial crash, but he's seen catastrophe ahead for decades here.
Say that I'm Dr. Realist, not Dr. Doom, but it's more catchy to be called Dr. Doom. Okay. And I think that warning about the risk is very important, because until now, we've been kicking the can down the road. We've been sticking our head under the sun like ostrich, and right now we're facing major mega threat.
So all in, we've got some great guests lined up. You do not want to miss that. Switching gears, earnings season is upon us with Delta Airlines due out tomorrow and the big banks set to begin reporting on Friday. But which company will set the tone this quarter? You can read all about the earnings bellwethers of the past, present, and future by subscribing to Yahoo Finance's Morning Brief. And today's edition was written by our very own Julie Hyman, of course, here with me on the desk and going to break down some of the bellwethers for us as well, Julie.
Yeah, first of all, what's a bellwether, right? That's an important note here. We're talking about something that is basically a signal or economic indicator, a company, for example, that sort of touches enough parts of the economy that maybe tells us where things are going. It's from the Old English for a sheep with a bell around its neck that you listen to find out if bad weather perhaps was coming. And so in the past, Alcoa was the first company traditionally to report its earnings. Alcoa, the big aluminum company. And it was not only the first to report, it was also seen as something of an economic indicator. Aluminum obviously used in a lot of different things in manufacturing. General Electric, another company that was seen in the past as an economic bellwether, but GE is a lot smaller now than it used to be, does not touch as many parts of the economy. And of course, the economy has changed quite a bit, is much more technologically focused, for example, and consumption makes up a much bigger part of the U.S. economy now than did manufacturing, for example, in the past. So I put it to my peers here at Yahoo Finance. I put it to some of our regular guests. Many of them were kind enough to answer me. Who did they think the new bellwether should be? I got a lot of different answers here. So if you look at some of those that came up when we did our very informal survey here, we got a FedEx and a UPS, which are sort of more classic bellwethers, right? Shipping around the country and around the globe. What's the demand as seen through the eyes of shipping? What does it tell us about employment trends as well, for example? Wells Fargo is one that one regular guest on the show mentioned here because it is consumer focused more so than the other banks, doesn't have as big of an investment banking arm, also is domestically focused. But then you have JP Morgan on the other hand, which of course is reporting tomorrow and touches so many different parts of the economy. So those were some of the names. Then we got a lot of tech names as well that people brought up, companies like Apple, for example, but other also consumer names like Walmart. WestRock, which you might not know, is a company that provides packaging. It's the second largest packaging company. Alphabet, of course, with its search and its really tendrils and everything advertising. So a lot to choose from. As for what I thought, which also was a vote of some folks, including the man sitting next to me, I thought Amazon was a pretty good proxy here. It doesn't report as early, right? It's due at the end of the month or beginning of next month, but it gives you an eye into the corporate demand because of AWS, because of cloud services. Obviously, lets you know what the consumer is doing because of shopping. And one of my colleagues said, well, maybe Amazon's not as good a proxy because it kind of adjusts, it has margin flexibility, if you will, based on what is going on with its profitability. But I think for the top line, it's a good measure of demand. And as for those margins, it does kind of let you know where the consumer is pushing back on some pricing. You saw Daisy Jones on there just because I liked the series Daisy Jones based on the book Daisy Jones, which is from Amazon Prime Video. So that's just my little mini capsule review of that adaptation of the book, which I like. So anyway, maybe Amazon can give us an idea as to what's going on in the economy. But obviously, we have to look at the ensemble of all of these companies. And as we tend to focus on the early reporting companies and those historic bellwethers, our next guest is looking at the broad trends rather than specific names. He's more of a macro guy. Let's welcome in Joseph Little, HSBC Asset Management Chief Strategist. And Joe, I guess I'll start by asking, when you're trying to figure out where the economy is going next, I'm sure you have a host of economic indicators. How much does corporate reporting also feed into your modeling and your scenarios?
Yeah, hi, Julie. Thanks a lot for having me on. I think it's a very interesting discussion. Who is the bellwether of the current environment? And you're quite right that it's interesting. Today, we're all talking about the CPI release. We're all looking at super core inflation. But I'm much more concerned about the developments on US corporate profits over the next couple of quarters now than I am about the developments on the inflation side. I think the inflation picture, it will take some time to improve, but we'll get there over the course of the next few months. The profits story, however, is the key leading indicator now for how the economic cycle is going to progress. So the broad trends for the first quarter earnings numbers are going to be what I am most focused on. I'm looking at the overall level of earnings, of course, the margins, the extent to which there's a squeeze on corporate profits coming from wages and nominal growth slowing at the same time. And I'm looking also at the guidance, the messaging from the CFOs and the CEOs about how they're seeing the outlook. And you're quite right on the names that you've observed. The early reporters, the big employers, the cyclical names, the industrial names are typically the ones that we would focus on. It's really the next couple of weeks. So I think this week around 4% of the S&P 500 is reporting. Next week we get about 14% of the market cap of the S&P 500. And the week after, that last week of April, we get around 40% of market cap for the S&P 500 reporting. So that's going to be a really big set of important and influential numbers and context to understand when we think about how the corporate profit picture is proceeding. And as I say, I think that's the key piece of the puzzle for when we think about what comes next in the macroeconomic picture as well.
And so are you expecting some type of guidance reset this earnings period, considering some of the uncertainty that has been cited, even for quarters that have already happened? It seems like we are sitting in the midst of that uncertainty based on what these companies have already said in the past.
Yeah, I mean, the puzzle, of course, this cycle has been that while we've seen a number of the key leading economic indicators that economists focus on, money supply, the PMIs, they've all begun to soften. The data on corporate profits and the data on labor market have remained very resilient. So I think one of your earlier guests mentioned the idea of long and variable lags of monetary policy. It takes some time, is what we've begun to see, for some of the implications of the most aggressive monetary policy tightening that we've seen since the 1980s to really have a big effect on the key economic activity indicators. But what the profits data is going to show us, I think, is that effect of a recession dynamic now coming into sight for later in the year is beginning to bite, it's beginning to squeeze margins, and it's beginning to pressure earnings lower. The good news is that the market has begun to adjust some of its expectations about corporate profits since the start of the year. We started the year with analysts expecting double-digit profits growth. It's around 0, slightly positive now. But the key question is how much of a profit slowdown and how much of a profits recession is going to be factored into the profits data and needs to be digested by stocks. And I'm a bit concerned that the market is still not prepared for some of the bad news that's coming down the pipe in the profits news in the first quarter and in the second quarter, and also in the third quarter results season to come as we move through the year.
So to put a fine point on that, that's really interesting that effectively you don't think that the outlook for profits has yet been priced in. So that seems to suggest we could have a bit of a painful earnings season.
Yeah, well, it happens gradually and then suddenly. Normally, Julie, as you know, the real source of the challenge for the corporate sector is a combination of forces that are really coming together at the same time. Nominal growth is already slowing. Interest rates have been moved higher materially at the fastest pace that we've seen since the 1980s. We've now got a credit squeeze, a credit crunch on top of that. And all of the while, as your previous guest also noted, inflation trends are pretty persistent. Wage costs, other costs for corporates are also high, which induces this squeeze on margins at the same time that sales numbers are under pressure. So I think it all boils down really to this news flow around corporate profits. And that's why the next few weeks are so important as we begin to see a little bit of information of the year about how those profit trends are playing out. It's not just about Q1 earnings, it's about Q2 and about Q3. It's a process. These economic forces take some time to play out. But my expectation is that it really begins with profits as the key leading indicator. And as we move into later in the year for both the US and for the European economies, we're looking at a GDP and labor market recession as well. And of course, for investors, that creates a significant amount of uncertainty, a very difficult outlook, an outlook where we want to be quite defensive about our investment strategies and asset allocations.
All right, we'll keep all of that in mind as we prepare, or maybe buckle up for the earnings season. HSBC Asset Management Chief Strategist Joseph Little, thank you so much for your time this morning. Coming up, we're going to take a look at Bed Bath & Beyond's stock sales. There's been a trend of the shares dipping on the selling amid dilution fears. That's not what's happening today. We'll have your movers next. We're coming up on the opening bell, so let's take a look at some of today's market movers. Bed Bath & Beyond kicks it off, up 2.3% after raising $48.5 million through the sale of shares. The beaten down retailer aims to raise $300 million by April 26th as it looks to avert bankruptcy. Who knows if it's going to be able to do that here. This amount being raised as of April 10th, so what are we, the 11th here this morning?
Yeah.
So it raised this money yesterday, and we're feeling it.
Yeah, so
I don't know what day it is anymore.
it's hump day.
Yes,
That
much I know.
As the youth call it.
It is
Yeah. So, even as we're thinking about what comes next for Bed Bath & Beyond, just trying to have some type of liquidity in this near-term period for the stores that they still operate. I don't necessarily think that there's been anything investors can hang their hat on as to what that comeback story looks like right now. It's still a question of what their credit facility looks like. It's still a question of how many stores they're going to continue to close. A list that runs 4 pages long, a 10 size 10 font as of right now, if you were to look on the company's website. And so all of that considered, it is still a long road even to getting towards what a stable new normal looks like for Bed Bath & Beyond, and there's going to be the liquidation of a lot of inventory just to continue to show their existing lenders that they can and have the ability to move through inventory, but it's a question of how much they're going to need to discount that too in this near-term period.
Yeah, I mean, it's so interesting the movements that we see in the stock too, based on all of this, right? That people get in when they see this kind of news. And I don't know that there's any kind of fundamental belief on the part of people buying the stock that it is going to continue to be in business, or just rather that, it's a sort of short-term trading opportunities, perhaps.
Right, so short-term that, and I actually have to credit Steve Sosnick on this, frequent guest of the show. He was talking about some of the people who were out there buying the options, paying the 1 cent for the $4 calls, saying and pleading for them to stop. because there are more sensible trades that you could make.
Sure, there are usually more sensible trades in the world that one can make, but All right, we got you some UConn action up there on the podium at the New York Stock Exchange. The NCAA champs there celebrating their victory. We got some cheers going on there too. Nice. Here at the opening bell this morning, even got a mascot up there. So as we look at stocks, as we open up here this morning in the wake of that CPI data, as our Jennifer Schonberger pointed out, indeed, the year-over-year increase is still substantial, right? We still have inflation that is sticking around, even if we have a slight amount of disinflation on a month-over-month basis here. All three major averages are trading higher here. The Nasdaq in particular, which, as we know, has been the most rate-sensitive of the majors. It's trading higher by 2/3%. Brad Smith, of course, is at the Interactive. What do we got here going on?
Well, over the course of this week, we are still net lower. However, you're seeing kind of a sharp move higher to try and combat that, at least in the Nasdaq Composite. Out of the gate here, it's up by about 0.5% past 3 days, though, still down by about 0.1%. And then also taking a look at the Dow Jones Industrial Average. That was the Nasdaq 100 we had pulled up. The Nasdaq Composite here, as you're seeing there, is up out of the gate by about 0.6%. And with that move higher over the past 3 days, up by about 0.2%. Back to the Dow Jones Industrial Average, though. You're seeing that come out the gate to the upside. That's up by about 0.5%. Past 3 days, looking pretty good. It's up by about 1% over the course of this week. And then additionally, the S&P 500, you're seeing that up right now in aggregate past 3 day period, up by about 0.6% here. And about the same on a percentage basis as we kick off today's activity. Let's take a look at some of these sectors as we are in the throes of just anticipation at this point for what earnings season could hold. We've been having a lot of those discussions. Keep a close eye on some of the sector activity as we move on throughout the rest of the week. As of right now, some of those staples getting hit right now down by about 0.2%, but the only laggard among the 11 S&P 500 sectors as of right now, and utilities says holds my beer as that entered into the laggards game as well. But anyway, technology, you're seeing that higher by about 0.8%. Also, communication services catching a little bit of a bid this morning. That's up by about 0.8%. We'll ride out with a quick look at those tech names in the Nasdaq 100. Some mega cap tech moves here early on out the gate. Tesla up by about 2.4% for the folks that are tracking it at home. TSL.
Yeah, bouncing back from some declines earlier in the week. Interesting action there, Brad. Let's talk about some other movers. We're talking Shopify. That stock greeted with an upgrade to outperform from JMP Securities. The firm does see upside to gross merchandise volume projections, GMV, which is something that Shopify and some of the other e-commerce platforms are measured by. The shares are up 7% this morning. They are up, I think, in the neighborhood of 20 to 30% thus far this year here as they get this upgrade. And the price target, $65 is what the analyst is putting on there, which represents some pretty significant upside from here.
Yeah, I've become a little bit more optimistic on Shopify, perhaps because of my own kind of purchasing habits at this point. I know that I don't go to the mall as much as I used to. I'm not cool enough to, but I do a lot more.
Do cool people go to the mall? Is that a thing?
I don't know. That's what they say, but they don't invite me. Anyway, for the cool people that don't invite me to the mall, perhaps you're doing a little bit more shopping on social media, and that's where I've found a little bit more of some of that inspo into kind of conversion of a purchase, and particularly Shopify is one name that has been very good at converting a lot of those commerce opportunities for small, mid-size, even large businesses through social and some of the partnerships that they have through the social platforms in itself. That perhaps in seeing more of that traffic now overflow into those experiences, and we always talk about what in-app purchases and the in-app shopping experience looks like. Shopify is a beneficiary of that at the end of the day. And so I think for all of the social media platforms that are trying to make their platforms more shoppable, and the number of small businesses all the way into influencers that are able to kind of capitalize on those eyeballs and the amount of screen time they're in, Shopify is one of the kind of intersectional beneficiaries in all of that as well.
Yeah, the analyst also talks about room for greater expense discipline, which is, we've seen from obviously a lot of the tech companies. And so reading between the lines, does that mean things like more job cuts, et cetera? So that's something, I guess, to watch out for at Shopify. That company, by the way, expect to report in early May.
All right. We're going to be watching for shares of SHOP. Also, Brookfield Infrastructure Partners agreeing to acquire the largest lesser of intermodal freight containers, Triton International, a deal worth $13.3 billion here. You're taking a look at the share price reaction here. Triton getting a big jump there by about 31% on this deal. Quite typical activity, company making the acquisition. You see them typically react to move lower. This is cash that goes out the door, capital that gets allocated towards this deal, and Triton, the company being acquired, typically has that type of reaction, typically means some type of premium being annexed here. But a big deal in terms of the infrastructural play. This one of the larger kind of Brookfield entities out there, as there are many to continue to track.
It's interesting to see this deal done in supply chain, right? After the couple of years that we have had and the sort of round trip that the supply chain business has made. And so when you're talking about these containers that get shipped all over the place, and Triton also provides logistics services, it's interesting to see that Brookfield is stepping in and making this acquisition at this point in time, perhaps banking on some recovery, some improvement in that particular business, or perhaps thinking that it can improve some of this. The company saying in a statement, it provides Brookfield infrastructure with a high going-in cash yield, strong downside protection, and a platform for growth in transportation and logistics. And we've got, by the way, another deal to talk about this morning on the topic of acquisitions. Emerson Electric is announcing it is going to be buying National Instruments for $8.2 billion here. $60 a share in cash is the per share price on this. You see National Instruments rising almost to that level. This is a 49% premium to National Instruments close earlier in the year, before reports that this deal might happen first surfaced on the and before the company announced a strategic review.
Yeah.
So at that point, it became clear that it was perhaps putting this up for sale. Emerson Electric has been pursuing it for quite some time and now has been successful in doing so. National Instruments, by the way, provides hardware and software for engineers and scientists.
Interesting.
In case it's not, a household name here.
Well, we're putting them on the map here and across every household out there. You mentioned the 49% premium on that deal, the deal for Triton and Brookfield Infrastructure, and this just to give you a glimpse of why these stock prices are reacting the way that they are here on the day. That Brookfield deal gave a premium of 35%, roughly 35% to Triton's stock, or at least the previous close coming into today. Also, coming up, everyone, revving up the EV push, why the Biden administration is cracking down on tailpipe emissions. That's next. The Environmental Protection Agency, known in your hood as the EPA, they just proposed the most aggressive climate regulations to date. The EPA's new proposed emission limits could require as much as 67% of all new vehicles sold in the United States to be all electric by 2032. Yahoo Finance's Rick Newman has the details on this one. Rick, what do we know so far?
Hi, guys. So this is a proposal. It's not a final rule yet, but they want to turn it into a final rule within a couple of months. Would really dramatically change the rules for pollution that's allowed from cars. So they're not mandating that automakers switch over to electric vehicles, but by really tightening up the pollution limits from cars, they're essentially forcing the adoption of electric vehicles. And they say, as you pointed out, Brad, the EPA estimates that if these rules go into effect as they are proposing them, that by 2032, about 2/3 of all new cars sold would be fully electric cars. It's less than 6% today. So that would probably be the most dramatic reshaping of the auto industry in its more than 100-year history. Now, I think there's going to be some pushback to this proposed rule from within the auto industry. I think they're going to say that's just too much change too fast. There are going to be some consumer critics who say, you're going to have a lot of unintended consequences here. You're probably going to push prices up for one thing. This could actually threaten the viability of some of the automakers that just happen to be behind on electric vehicle technology. So I don't think it's going to go into effect exactly as we're seeing today. But clearly, the Biden administration is pushing really hard to get auto emissions down and make that a huge contribution to getting carbon out of the air.
Rick, so you said this is the proposal, right? It might not go into effect that way. Like, what happens now? What's the process?
It's a standard part of the regulatory process, Julie. So it's open for comment. And what that means is that they've published this proposal and they've said, here is the rule we want to enact. And this is all regulatory. This is not something that Congress is doing by passing a new law. So a lot of people in the industry, there's going to be tons of comment. I'm sure there's already all kinds of lobbying going on behind the scenes. The auto industry probably had a pretty good idea this was coming. The auto industry is not saying this is a terrible idea, we stand in opposition to it. I think what they're very likely to say, though, is it's just too much too fast. And, it's going to be too disruptive to change the technology this fast. I mean, we're talking about changing, you can't just change out a few parts on an automotive assembly line and turn it from producing gas-powered cars into electric cars. I mean, you have to either build new assembly lines or build entirely new factories. I mean, we're talking about billions, many billions of dollars it takes to do this. All of these trends are underway, but I think you're going to hear the auto industry saying, look, we're already going in this direction. Some of the automakers have even said they plan to make only electric vehicles by 2035 or 2040. But it makes a lot of difference how fast you get there.
All right, Yahoo Finance's own Rick Newman tracking all things surrounding this EV push here. Rick, appreciate it.
Bye, guys.
See ya. Coming up on the other side of the break, cannabis consolidation. We'll speak to the CEO of Tilray on the company's latest acquisition plans. There's Erwin. We'll see you next, Erwin.
watching shares of Tilray today. They're recovering just a bit. Investors looking at the stock again after it dropped 8% yesterday. That's after it announced its plan to acquire fellow Canadian cannabis company HEXO. Also reported some weaker third quarter numbers. Tilray CEO Irwin Simon is joining us now. Irwin, it's a pleasure to see you. Thanks for being here. You talked on your conference call, and we talked to Vivian Azer also yesterday, who tracks the company, about the challenging Canadian market right now. And I know the conventional wisdom is sort of you get bigger to deal with the challenging market. Can you walk us through exactly how the HEXO acquisition helps you deal with that challenging Canadian market?
So, Julie, good morning. Always nice to see you and your partner there, Brad. Listen, I come back and say, listen, markets are challenging out there in the cannabis industry. Number one, it's only 4 years since cannabis from recreational has been legalized. Number two, there's all these LPs in place today. There's over 1,000 LPs. There are multiple retail stores. And with that, there's got to be a company out there that takes that lead position. It's no different than any consumer packaged goods. You know, at Hain, I did that with Hain Celestial in the natural organic food industry. And a lot of that has to come from consolidation, but consolidation's got to be right. And there's been a lot of deals done in Canada. And, you know, a question asked to me yesterday is there was deals done just for the sake of deals done and multiples that were paid that never worked out. You know, that's not the case. With Tilray and Aphria coming together, there was a lot of synergies, there was a lot of savings. And that's why Tilray has, you know, over an 8% market share. You know, with HEXO, listen, Redecan is a great brand. There's a lot of great brands within HEXO. And with that, not only getting the synergies, Julie, you also got to get the growth there. And a lot got to change in Canada in regards to how you market the brands, in regards to how you educate consumers about buying the product. Listen, Canada is the only country in the world where adult use cannabis is legal. So ultimately, Canada is ultimately put their foot out there, and they're kind of responsible for the rest of the world to sort of show, hey, here's how we do it, here's how we market it. And by the way, the Canadian government is making a lot of tax dollars from this too. So they got a vested interest to make sure this works in Canada.
Right, yeah, definitely setting the tone for the rest of the world. So talk to me then, you mentioned the Aphria acquisition, now the HEXO acquisition. How big is big enough to move the needle? Or do things on the ground need to improve in Canada before you can benefit from that added size?
Listen, things got to change on the ground. And I think educating consumers, you know, the quality control, the regulatory when you're buying recreational cannabis, is it just like buying alcohol from a medical standpoint in regards to pain, in regards to anxiety, in regards to sleep, the benefits from it, and, you know, declassifying it as a drug. So there's a lot to do. And, you know, one of the restrictions in Canada is what you can advertise and what you can say and educate about the safety of it. So there's a lot very important things that got to get done. Listen, the other big thing is, you know, working with the Canadian government on the excise tax. Tilray alone pays over $120+ million in excise tax alone. You put it together with HEXO, they're paying another 30-40. So, you know, ultimately, we're paying way too much excise tax. There's been price compression there. Us alone, $30 million, which drops right to the bottom line. So there's got to be something done in regards to excise tax here. And again, listen, there's an illicit market out there. It's out there. There's illicit markets in everything. But how do you educate consumers how to buy products that are legal, that are regulated, and that are good quality products? And Julie, step back for a second. What we built at Tilray is a diversified company. We're a CPG company. We're a cannabis company. We're in the spirits business. We're in the beer business. We're in the cannabis business and the wellness food business. And one day, they're all going to come together. There's going to be beer infused with THC. There's going to be, you know, bourbon and vodka infused with THC. There's going to be foods infused with THC that has multiple uses.
Yeah, Pigeon Forge, Tennessee knows a fair bit about the infusion of both of those things together, both weed and on the distillery front there. You know, when you think about what this looks like from a kind of consumption perspective here, or at least the consummation of the deal, what are the key performance indicators that you would look to say that this deal was a success? And over what time period would you start to see, after the deal is complete and finalized, some of those benefits start to filter through to the business results?
Good question, Brad. And listen, you don't do deals just for the sake of doing deals. And I think there's a number of things that you got to look at. What you pay for the deal, number one, and we think we paid a very attractive price and benefit both, you know, shareholders for Tilray, and ultimately benefit HEXO shareholders where they're becoming part of Tilray. and they get a bigger bite and they're part of a bigger company. Number two, we've talked about synergies and savings. In the first year, we're looking for $25+ million of synergies and savings. Yes, you get those once. Once you get the synergies and savings, how do we grow share? Combined share today is about 13%. We need to grow share double digits here. And that's the important thing, is how do we grow share? And share's got to grow, from taking it from our competitors and also bringing new users in there. And at the end of the day, listen, how does it really show? Earnings per share. EBITDA contribution for our shareholders. Our shareholders got to win here, and 1 + 1 got to equal 5, not 3, not 4, 5. And ultimately, the objective of myself and my team is how we make Tilray a bigger company on a global basis. And the big thing here is one day legalization will happen, in the US. There's talk today about what's going on in Germany. What are the learnings coming out of Hexo? What are the learnings coming out of Redecan? What are the learnings coming out of Tilray that we can use around the rest of the world once legalization does happen?
Well, Erwin, I guess I really want to try and pin you down a little bit on timing. You don't have any control, right, over whether legalization is going to happen in the United States or other places around the world. What you seem to be doing is sort of assembling all the pieces, right, on the beverage front, on the cannabis front in Canada, and you're sort of poised once things change. What is your message to investors as to when they can expect that EBITDA, right? When they can expect all of these pieces to then be fired into action?
So, Julie, they're firing into action today. Look what we own in assets as a global company. Look what we have in a diversified portfolio. But they're all adjacencies. We're just not a roll-up strategy. They're all adjacencies to cannabis, spirits, beer, and wellness foods. And one day, infused with THC. And THC, listen, as I've said yesterday, to a lot of our investors, and I said to analysts, THC is a medicine. THC is an adult use. It's similar to alcohol. It's similar to, it's similar to, sorry about that. It's similar to medicines, okay? So with that, there is tremendous opportunities here. And if you come back and think about the opportunities here, look at the size of the medical business. Opioids, the opportunity that's going to replace in opioids and stuff like that. So I see a big opportunity. And Tilray as a company, really, we've been around 4 years between Aphria, Tilray, and the rest of our brands. In regards to our balance sheet, the company today has over, $480 million of $450 million of cash on our balance sheet. And, with that, hey, we're ready and poised for growth in many different areas.
Erwin, while we have you...
There's no fire I don't have to run, so don't worry.
Okay, good.
While we have you, when we think about even some of the inflation readings that we've been monitoring here, and where consumers have been monitoring where their prices have been impacted in one direction or another, where they're starting to abate or where they're still remaining stickily high year over year or even month over month, what has that been like for the cannabis industry, and especially considering some of the brands that you do own in the beverage division where prices have had to go up in one way or another? Are you starting to see that abate? Is there any insulation then on the cannabis side of the business that you're seeing? What is that breakdown from your perspective?
Brad, the bizarre thing is in the cannabis industry, there's been price compression here, okay? I mean, our prices have come down in the cannabis industry. And as I said, close to $30 million of cannabis prices have come down this year in the Canadian market. In regards to the U.S., beer, can business, our beer business prices have gone up, our spirit business prices have come up. And what we're trying to do is become those low-cost producers. And that's one of the advantages of doing acquisitions, is where you can roll these smaller companies together and have a bigger platform where you can take out multiple costs. So I'm big on acquisitions. Julie, as you know, I've done over 60 plus acquisitions at Hain to build that out and took out a lot of cost and use the infrastructure to grow. And that's things we're going to continue to look at Tilray to reward our shareholders with bottom line profits.
Tilray CEO Irwin Simon joining us here today. Irwin, we appreciate the time breaking down some of the details of the deal as well as what the prospects look like for Tilray going forward from here.
Thank you very much. Nice to see both of you.
Good to see you too. Awesome. All right, well, switching gears here for our chart of the day today, we're zeroing in on the housing market. 30-year fixed mortgage rates falling for a fifth straight week to the lowest level in 2 months, which means demand for home buying is back on the rise. Mortgage applications rising 8% last week. Compared with the previous week, they were, however, 31% lower than the same week 1 year ago when interest rates were significantly lower. Now, this is all according to Mortgage Bankers Association data here.
Yeah, some good news that we're seeing these mortgage rates come down, at least if for those who are in the market for a home. But like that chart makes pretty clear, even though the trend is lower, it's still a lot higher than it was. You know, we are starting to see some of the housing data maybe improve a little bit. The housing prices maybe improve a little bit as well, but it doesn't look like it's a more significant moving of the needle as of yet.
Right. We were talking about the average pricing, especially from the data that came through from the National Association of Realtors as well, how that has at least retracted a little bit, and one of the first declines of that magnitude that we had seen in something like 11 years. And so that is going to be considerable for those who are on the buying part of the market. For sellers, not the best news, but hey, us buyers need an opportunity.
I mean, maybe not the best news, but it's still a lot higher than it was a couple of years ago. So still benefiting from that bump up, I guess.
Absolutely. Well, coming up, everyone, from hot inflation to banking turmoil, we will speak with IBM Vice Chair Gary Cohn on the other side of this quick break.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. And let's take a check of the markets here. We got U.S. consumer prices that did rise in March at a slower pace than they did the month before in the headline number, but underlying still seeing some sticky inflation, if you will. I want to start with rates here because we are seeing a little tiny pullback in rates. Really can call this not much change, especially given the anticipation for that CPI report. But we are not seeing a lot of change here, just down 2 basis points on the 10-year to 3.41. 1%. If you take a look at the 1 month here and the changes that we've seen, obviously you see a lot of up and down as we have seen expectations change for what the Federal Reserve is going to do next. But overall, the movement over the past month has been downward in rates. And getting back to stocks here and what we're seeing in terms of individual movers, earlier we have been seeing more strength in the Nasdaq. Here are the Nasdaq 100 movers. Brad checked Tesla at the open and it was up something like 2.5%, and now it has gone back to unchanged. So that's an interesting move here as we are giving up some of those gains that came immediately in the wake of the inflation report. Likewise, let's take another look at the sectors that Brad checked just a little while ago. There we are not seeing as much movement, but everything's in the green, but it's sort of modestly so, right? And you've got real estate in the pole position here, up by 0.7%, financials as well gaining, and of course, now we're done with CPI. Attention is going to turn to the banks that we're going to be reporting at the end of the week, Brad.
All right, we're going to be keeping close tabs on that, of course, from persistent inflation to turmoil in the banking sector and throughout a nervous financial market, watching its every word. The Fed has been between a rock and a hard place for some time now. So does today's inflation reading move the dial on policy, or are we still some way from a clear picture of the road ahead? Here to discuss this and much more, Gary Cohn, IBM Vice Chairman and former Director of the National Economic Council. Gary, great to have you here in studio with us.
Thanks for having me.
Absolutely. All right, so help us kind of parse through that first question there. Does this inflation reading today really change the equation, the calculus for the Fed?
I'm not sure it does. I mean, we came in sort of right on where everyone had predicted we would. We came in at 5% overall inflation, about down a tenth from where people thought we would. But if you look at core, which is, I think, where the Fed spends more of their time, core is still relatively sticky. We're stuck at 5.6%. You take out food and energy, which we know are very volatile components. And we know that energy has moved a lot since the last month reading. We've seen that oil prices have gone up quite dramatically. So I think the Fed is going to sit here and sort of contemplate what they have done. We know that the chairman has talked a little bit about the lag effects and the cumulative effects of monetary policy. He's weighing that on one hand. Clearly, what are the long-term effects of what we have done? On the other hand, he's looking at the banks. He's looking at the mark-to-market losses that banks have by buying the most secure asset they can buy, which is a U.S. Treasury bill, which is a zero risk-weighted asset. It's what they encourage banks to buy. And he's trying to weigh those two countervailing forces. Overall, their mandate is to get to 2% inflation. So at 5%, we're still 300 basis points above the overall mandate. And I think the chair is going to have to weigh those issues. We're going to get some more information this afternoon. We'll get the Fed minutes this afternoon, so we'll see what they were thinking during the last Fed meeting. Now, the last Fed meeting, people will probably discount those minutes because we've had an awful lot of disruption and instability since the last Fed meetings. Sure. But it will be important to see what people were thinking. It will be important to see what the discussion was a month ago.
And so the market's still pricing in this quarter-point rate hike in early May. What does that mean for the economy once that happens, right? And I mean, does it feels like we're in a little bit of a holding pattern now, especially as we're waiting for earnings?
I think we're in this, I don't know if it's a holding pattern or at the end of the cycle pattern. It feels to me like we're at the end of the cycle pattern. The debate is 25 basis points, pause, pivot, or are we getting ready to pause? Is the 25 basis points not going to happen? I think I'm more or less in the 25 basis point camp now because, I think with the 5% reading here, banks somewhat stabilizing. We've seen a lot of movements in deposit flows, and we have to sort of evaluate that because, one of the things that the chairman said during the last press conference, and I think this is very important, is that lending conditions in the banking community are changing and changing quite rapidly. We've seen a lot of deposits move around the system. We've seen deposits move from small regional banks to larger banks, and then we've seen deposits move out of larger banks into money markets and treasury funds. So there's less money in the system to be lent out. Once banks have to hold their excess reserves, they can lend the remaining balances. But the remaining balances today at banks are relatively low. So the banks themselves are contracting the economy. The Federal Reserve Board understands that. I think they're trying to understand what the magnitude of that is. I've seen reports where the magnitude of that is equal to somewhere between 25 and 75 basis points of increased interest rates. So we have to understand where that is. So I think we're sort of at the end of this cycle. And that's why we're in this sort of holding pattern. We're holding to see what the Fed's going to say, what Powell's going to say now that we have this banking, the sort of banking data behind us, that we've seen reserves come out of the system, that we've seen this flight to money markets, we've seen a flight to treasuries. How do they evaluate the tighter lending conditions, and how does that influence their decisions? That's why I think even when you see a more positive inflationary report today, you didn't really see a large interest rate move. You didn't see the moves that we might expect.
And so, as we're waiting for what those minutes reveal about how the Fed members and the Federal Open Market Committee members are speaking, you have a line of communication that's into a lot of bank CEOs that many people don't have. Of the conversations that you still have with those profiles, people who are running the largest banks here in the U.S., what's going down in the DMs? What are they telling you? What are the text threads like right now, or the conversations, especially around their sentiment in the current economic environment that we're finding ourselves in?
Well, I think everyone's concerned about liquidity. Everyone's concerned about lending conditions. Everyone's concerned about the real estate market. We hear everyone talking about the commercial real estate market and all of the loan maturities that are going to happen over the remainder of the year. Mm-hmm. A lot of that commercial real estate lending has been done in the, I would say, mid-tier banks. So the bigger banks are trying to figure out what effects that's going to have. The mid-tier banks are trying to figure out what effects that's going to have. The loan to values are going to change quite dramatically. We see a lot of empty square footage. We see the prices coming down. So there's an evaluation of what's going to go on in asset quality. There's an evaluation going on in liquidity and liquidity standards. I think people are concerned, will there be a overstep or a misstep in regulation into the banks? So banks are always concerned about additional regulatory costs, additional regulatory hurdles. And what does that mean? So holding more liquidity and holding more capital is always a good prophylactic against another regulatory move. Mm-hmm. So I would characterize banks right now in a relatively conservative mode. You're right, we will see bank earnings later this week. But remember, that's a backwards looking phenomenon. And we are, and I think we say this a lot, we're in a very volatile time. It's a lot less predictive of this quarter, what happened last quarter, because of the amount of money that we've seen move around the system. Move from small banks to medium banks to large banks to money markets and treasuries. We really have to sort of reevaluate what banks are going to look like and what they're going to do going forward.
So I have sort of two follow-up questions to that. Those concerns about liquidity that you talked about, as we see the deposits flowing from the small banks to large banks into money market funds, et cetera, are those liquidity concerns justified, do you think? In other words, are we going to see some more blow-ups among the banks? It feels calm right now, like it has been revealed, but has it?
So I remind people that every year we lose banks out of the U.S. banking system. So, since Dodd-Frank, I think we've lost since the Dodd-Frank legislation after 2008, we've lost over 10% in the banks of the United States. So we've had this slow grinding, whittling away of banks in the United States. I think we're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis, but we're in a situation where banks were sort of flooded with deposits during COVID, flooded with deposits during the crisis. A lot of it was government stimulation. A lot of it was people just had money coming in. There was no way for people to spend money because there was no consumptive ability except for things that could be delivered to your house or you could buy at the grocery store. So your ability to consume money was fairly low, which meant there was no loan demand for banks. So banks were seeing deposits come in on one side, and they were seeing nothing going out on the asset side. They weren't able to lend money to people because people didn't need to borrow money. So all of a sudden they were in this position where they had huge excess reserves. And the natural thing to do was to go out and buy some interest-bearing, low-risk asset. The most unique low-risk asset in the United States is a U.S. Treasury. Then we saw this massive move in interest rates, close to 500 basis points. So it's virtually impossible that banks don't have big mark-to-market losses on their balance sheet. We know that they all have big mark-to-market losses. Now, some of the bigger banks run those through their year-end stress test calculations. Some of the smaller banks don't, but we're getting more and more transparency to what banks' tier one capital looks like on a mark-to-market basis with their hedges, and we're not through to the other side of this. So nothing has changed in the banking sector from where we were 6 weeks ago, except we understand what happened at Silicon Valley Bank, we understand what happened at Signature Bank, we understand the mark-to-market losses in the available for sale and the hold-to-maturity buckets.
The other thing you mentioned is the best prophylactic against regulation is increased provisioning, right? Increased reserves at the banks. They're about to report. We're probably going to hear. There's been some reporting around the amounts that we might hear from the banks. Should we be alarmed or reassured by that money that they're putting aside?
I think all the banks are going to talk about the excess liquidity they have. I think many of the banks will talk about their insured to uninsured deposit ratio. I think they'll talk about their mark-to-market losses that are disclosed and non-disclosed in their hedging books and what the asset side of their balance sheet looks like. I think banks will go out of their way to give you more disclosure on what their portfolio looks like at this time, because I do think that is a good prophylactic. If you're trying to fight the knee-jerk reaction in Washington, which is just something bad happened, let's go regulate, show that the U.S. banking system as a whole is very, very well managed. It went into this whole scenario very well capitalized. And I think the bigger banks are going to go out of their way to show you how well capitalized they are.
You had previously, back in 2017, I believe, called the Dodd-Frank do-over a win for banks, but there was some deregulation that took place with that Dodd-Frank do-over as well. Did that reinsert unnecessary risk into the system that now caused some of the very crisis that we're seeing right now?
Early after Dodd-Frank came out, I did say, look, you had put a moat around the largest banks in the United States. You had put the regulatory burden so high on those banks that it was virtually impossible for any bank ever to cross into that moat. So you were almost protecting the largest banks in the United States. And the too big to fail was almost too big to compete with, because the regulatory costs that they were going to have, and no other bank would want to get to the other side and have all those additional regulatory costs. And so those big banks became more and more secure. And we saw that. We saw the flight to quality a few weeks ago was into the biggest banks in the United States, because no one feared the biggest banks in the United States because they are so big. You know, we in the United States have a very robust regulatory process at all levels, at all size banks. All size banks go through a robust regulatory system, whether it's a state bank or a federal bank. The question to me is, once they're going through the regulatory process, how vigilant are those regulators? So the problems at Silicon Valley Bank were really well identified. The bank was given, notice in a way that they had an interest rate problem, whether it was a matter needing immediate attention or a matter needing attention. The issue to me was there follow-up from the regulators on making sure that that matter was taken care of? I can tell you from great experience that if you were regulated by the New York Fed, they would not forget to follow up every day. If they had sent you a letter like that saying, hey, look, you've got a fundamental problem in your hedging book, you've got a mismatch in your asset liability, they would be talking to you every day about managing that. The question was the San Francisco Fed as diligent and rigorous as the New York Fed? We don't know. It may turn out they are, and it may turn out that the Silicon Valley Bank just didn't move quickly enough to deal with their problem.
I want to switch gears and talk about what you're doing now at IBM. Maybe it's a relief now to not be in the banking business while all this is going on. Not that the tech business is calm and quiet and unturmoiled right now. So how are you thinking about tech growth as we go through the year? We talked a little bit about this back in January at Davos amidst this tech environment that is a little bit tough right now.
Although if you look at the overall tech world, Q1 in the tech world, I think it surprised everyone to the upside. We saw this rotation out of the energy world and out of some of the industrial companies back into tech. Tech probably was one of the leading sectors in Q1.
Yes, unless people are setting themselves up for disappointment this earnings season, hopefully not.
They may be, but I think what you saw in the tech world as a whole, let me talk very holistically and very generally. The tech world as a whole, I think, understood that we were going into a tougher economic situation. Many of the companies got down to the fundamental basics of how they ran their companies. Most of the tech companies, Silicon Valley related especially, really grew significantly during the crisis, during the pandemic. They were the ones doing massive hiring. They were growing. They were growing exponentially, some of them. I think as we got into 2023, many of them said, hey, look, we just can't grow at a headcount. We just can't grow at all costs. We have to right-size our business. We have to right-size our footprint. We're going to have to get ourselves into a more competitive posture. And that may mean making tough decisions and downsizing on headcounts. And we've seen a lot of that. We've seen a lot more layoffs coming out of the technology sector as a whole than almost any other sector. So we've seen the technology sector taking pretty aggressive actions in right-sizing their companies, trying to figure out where the economy is going, where the demand's going, how they're going to continue to grow, how they're going to continue to be good shepherds of capitals for their shareholders. And the market has responded by rewarding those stocks because management has gotten in front of the newfound emphasis on making sure shareholder returns are adequate. So, technology has been a good place to be so far in 2023. I still feel like it is a good place to go. We are a technology-driven country. We continue to find new areas. The whole AI machine learning space. It's a space that people in the industry have known about for a decade plus, but it's now becoming a very retail piece of the equation. So we continue to see new routes of evolution, new routes of expansion in the whole technology world. And I think the biggest companies at the end of the day will be the winners in this space. As you've seen, the biggest companies, if they weren't the inventors of some of these products, they clearly had the balance sheet and the capital to go out and buy or get invested in some of the newest products that exist. So look, my view is the technology business in the United States is continuing to grow. It's a robust place to be, and is a big differentiator to the U.S. capital markets and the U.S. economy.
So I know you want to follow up on AI, but first I want to ask you a little bit more about the sort of expense rationalization and a little bit of shrinking. IBM announced some job cuts earlier in the year as well. Not a huge number relative to the size of the company and relative to what we've heard some others. Where are we in that cycle? Could there be more cuts at IBM, for example, do you think?
So I'm not going to talk specifically about IBM. We're in an earnings blackout. So that's why I'm going to talk generally about the industry. I think the industry right now understands that there's a lot of competition and that making sure that shareholders are getting an adequate return on capital and that management and boards are being good stewards for capital is very important. Where when you were in 40, 50, 60% growth modes, you had the ability to hire and try and expand and grow your business. Since growth has slowed down across all industries, so all industries means your clients are also slowing down as well. You have to manage your expense model more diligently and more rigorously. And I think that you're seeing that across all of the technology industry.
Artificial intelligence is having perhaps its baggy jeans moment right now. They were popular back in the early 2000s and now once again popular. So now we think about
at least you remember it was popular in the early 2000s.
Yes,
Many people think it's brand new.
Right, exactly.
I mean, I remember Watson on Jeopardy. So
precisely.
There you go.
Right. And so all of this considered, I mean, for any company that has annexed anything generative AI to their future announcements, to how they're embedding it within technology solutions, it is lighter fluid to their stock price, to how much eyeballs they get. All that to say, IBM's been doing that, right, for a while. And so now when you think about generative AI or artificial intelligence as a whole, as an economic input, what do you think about in terms of what that means for productivity, what that means for the employment situation, and how the broader economy may shift as a result of that?
Look, we have seen very few things in our generation that have really changed worker productivity. What's in front of you, the laptop or the computer, was the last major shift in worker productivity. AI and machine learning could be the next big leg in worker productivity. what machines can do with humans can make human capital so much better at what they do, and can allow them to move faster, and it can allow people within the organization to be much more efficient at what they do. So to me, it looks like it could be a major productivity gain in allowing machine learning and AI to be part of an organization. Now, it's not going to happen overnight. Just like the laptop, the first version of the laptop computer didn't have a instantaneous effect, but as it got better and better and faster and more software was written, it became a really productivity enhancing tool. Machine learning AI, we think, will have enormous impact on the productivity of the US labor force. And it will allow people with different skill sets to be much more effective at what they do.
Does that mean displacement, or does that mean in tandem from your perspective?
I would say in tandem.
In tandem, okay.
Well, that's a good place to
Yes.
end it, I think, on an optimistic note. Gary, thank you so much for coming in. Great to see you in person and not in a freezing outdoor Swiss hillside. Gary Cohn, Vice Chair of IBM, thank you.
Thanks for having me.
I want to get you one quick trending ticker. Shares of the company formerly known as Weight Watchers, WW International, that is, coming back down to earth after soaring to nearly 59% in yesterday's trading session. That came after the company closed its deal to acquire Sequence. That acquisition will provide WW with Sequence's ability to prescribe anti-obesity drugs. That's a hot area right now, as WW looks to enter into clinical interventions for those who medically qualify. The shares coming down a little bit today, off by 4%. Coming up, as earnings season ramps up, what does this mean for big tech? We just talked about it a little bit. We're going to get a preview next.
The technology sector has gained nearly 20% in 2023, but this newfound strength is about to get put to the test come earnings season. For more on what to expect from the tech earnings this quarter, let's get to Yahoo Finance's Ali Garfinkel. Ali, what are we keeping tabs on?
Good morning, Brad. So looking at the markets, you wouldn't know it, but tech is actually on pins and needles right now. On one hand, right, you have the sense that that rally looks pretty good. And on the other, there's a lot of concerns about the Fed and a sense that the sector is a little bit unsteady. So I talked to a bunch of analysts trying to understand why, and sort of a group of key themes emerged, and there were actually a lot of them. There were 4 of them that everyone brought up time and time again. And I'm just going to break them all down because there's a lot to get through. So first, number 1, the Fed, right? It's not a secret that tech was slammed by rising interest rates in 2022. And the idea that we're seeing behind this rally is that there's maybe a light at the end of the rate hike tunnel. Now, we don't know that for sure, though. And what the Fed does next will determine tech's priorities, right? So let's say the hikes continue. The focus then will stay on profitability and cost cutting. If there are no more hikes, though, we're back in business. Tech growth mode is a go again. However, we don't know that, and I think the assumption that growth mode could be a go again soon is maybe dangerous in setting up investors for disappointment. Now, next, digital advertising and cloud slowdowns. It's interesting because my inclination wasn't to put these together, but every analyst I spoke to was inclined to put these together, sort of describing them as these twin slowdowns. Now, what does that mean, right? Digital advertising, on one hand, is further in the cycle. We've been talking about the digital advertising slowdown now for 6 months, 7 months, 8 months, a year. It's been a while. However, the cloud slowdown is relatively new. In my conception, we really started talking about it. It really started hitting headlines back in Q4. I'm going to remind you of some of those Q4 numbers. Amazon Web Services actually reported a sales miss. It was a small miss, 21.3 billion actual versus 21.76 billion. However, that kind of slowdown is existential for Amazon. I don't know how many times I've said on this show that AWS is a stalwart of Amazon's business and has bolstered a lot of growth in other areas of the business. The same, to a certain extent, is true of Microsoft, which in Q4 also warned that there were going to be these slowdowns in cloud growth. So the bottom line on these kind of twin cycles is digital advertising is further along and people are more comfortable with it, and cloud is less far along, and it's made some folks out there uneasy. Now, I'll bring up AI really quick. It's going to come up in these earnings calls, but one important thing to remember about AI is that for some of these companies, there will be material effects imminently, but for most of them, those are very far down the line. I'd actually like to direct you to a PwC statistic that AI could contribute 15.7 trillion to the global economy by 2030. There's a reason that's 2030 and not 2025. This technology does still need a moment to develop. However, it is developing fast enough that we will see it discussed. And I think it's important to say AI has given people in tech a lot of optimism, a chance to think about the future after what the last year especially has been tough. Now, the last thing, of course, is layoffs. I believe, according to layoffs, FYI, about 170,000 people in tech have been laid off in 2023 so far. And what is going to happen in this earnings cycle is we're actually going to start to see some of the numbers come down about what the kind of money that has saved for these companies. I'd actually love to read you something that Andrew Boone, an analyst at JMP Securities, said to me just yesterday. We're going to see the numbers behind the cost discipline story, and that's going to be one of the drivers of stock performance over the next 6 weeks. Now, to bring this all full circle, right, we're going to go back to the Fed. If the Fed continues hiking rates, that profitability is going to be that much more important. And of course, the question that everyone asks about layoffs is, when do they end? And I think it comes down to, we don't know, and it depends on the Fed to a certain extent. So if you're out there and you're like, well, okay, what's the bottom line of all this? I heard the word cycle over and over again. Business cycle, rate cycle, hype cycle, as referencing AI. And the sense I got was that tech is sort of trapped in this pile-on of cycles that are going to take some time to iron out. But until that moment comes, I think a lot of analysts are going to still be asking the question, where is the bottom? And I think nobody knows the answer.
I guess we'll find out. Thanks so much, Ellie. Appreciate it. And sticking with tech, let's talk about Twitter. I don't know where the bottom is there either. It no longer exists as a publicly traded company. In fact, it no longer exists as a company called Twitter at all. Elon Musk moved his entity into his privately held X Corp, and he opened up on his experience buying and running Twitter in an interview with the BBC. In it, he said running Twitter has been, quote, quite painful and a roller coaster, admitting that he only went through with his Twitter purchase because, well, a judge was about to make him. Still, Musk made it clear early on that buying Twitter is an accelerant to his original X.com vision. When asked about the company's finances, Musk told the BBC that since taking over in late October, Twitter is now roughly breaking even. He acknowledged glitches, including outages on the site, noting that they haven't lasted very long and that the site currently works. And more importantly, Musk says Twitter could be cash flow positive this quarter if things keep going well. He told the BBC almost all advertisers have come back or said they're going to come back. Of course, it's a privately traded company, so we don't know if that's actually what's happening.
And to what volume the advertisers that have left have come back as well. It's one thing to say that all advertisers have come back. It's another thing for an advertiser to diminish the amount of spend that they're putting forth on the platform. And of course, that could have some correlation to the amount of advertising spending that has been pulled back, whether digitally, out of home, or in quite frankly, any capacity, as a lot of corporations are just trying to figure out, all right, what our actual marketing spend needs to look like, even as we're restructuring some of our internal costs. But for Elon Musk and how this shell company X is going to move forward, there's been so much focus around where X would have kind of this umbrella over top of all of the Elon Musk touching entities, and if that would actually be the company that perhaps doesn't get publicly traded. I mean, he's already talked about how he doesn't like running publicly traded companies, saying in the past that if he could take Twitter private again, he would, or not Twitter, Tesla private again, and even teased and then got into trouble about trying to take Tesla private. There's been, of course, all of the hullabaloo surrounding Elon Musk and wanting to have privately held companies so that he could have more freedom and less of the fiduciary duty to investors or shareholders at the end of the day. But at the same time, if you did have X as a holding company for all of this, I think the larger question is, how do each of these entities become overlapping or touching at one point or another? And that's where I think for anybody who is just on Twitter and is trying to figure out, all right, what is the future specifically for Twitter and either where I get news or where I engage with friends or where I keep my influence or livelihood, what does that look like in the future? And I think Elon still has left people on the end of their chairs unanswered questions in this near-term period of time.
Yeah, something else he talked about in the interview was the idea of paid verifications, Twitter Blue, paying for the blue check marks, and he said he doesn't see any social network surviving without paid verification. We should mention this news comes as NPR, National Public Radio, said it is taking a break from Twitter, suspending its account on Twitter after a dispute with the platform over how NPR was labeled, whether it was a government-sponsored news source or not. NPR says it gets government funding, but it is not. It is an independent news organization. So interesting there that happening right after the interview.
Right. New York Times essentially got the same labeling there. So it's a question of now, okay, we have to go. But is it what Elon Musk deems kind of verifiable information, the information that he likes versus what he doesn't? Anyway, coming up, our next guest says that the market is pricing in a thematic cocktail ahead of the next Fed decision. We could use a cocktail ahead of that decision. We're going to discuss the cocktail and the decision next.
President Williams, thank you so much for sitting down with me and for having me here at the New York Fed. I want to kick off the conversation with your reaction to the March jobs report. Does it give you any assurance that the job market is starting to come back into balance?
I guess when I look at that, it seems like job growth is actually quite strong still, even in the latest data. So yes, we are seeing some slowing in the demand for labor, but the demand for labor is still very strong. Labor market is still very strong.
So then, given your assessment of the job market and new developments we've seen with OPEC cutting back on oil production, how does that inform your outlook for inflation?
But inflation is still very high, and I would just mention that some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
What are you seeing in terms of credit conditions? position?
Right now, it's still pretty early days in terms of seeing clear signs of changes in credit conditions and credit availability. I'll be watching that closely to see those signs and then see, any broader effects on consumer spending, business spending, and other parts of our economy. So right now, you're not seeing any strong signs of those effects happening, but it's something I'm very much watching for.
How do you view financial conditions now?
And I would highlight that central banks around the world have been tightening monetary policy. So I think that financial conditions broadly have tightened in the way you pretty much expect, given monetary policy moving from very accommodative to now somewhat restrictive.
And how does that inform your thinking for the policy path and ultimately the peak on the Fed funds rate?
I think the question for us is to really watch the data. We got a lot of data coming, obviously on the retail sales and CPI and a lot of other indicators, and see what are we seeing in terms of the demand, the trends in demand, both in the economy and in the labor market, and what we're seeing in the inflation data.
Let's say we get to the fall and inflation's still high, it's not coming down. What is the prospect of needing to resume rate hikes after you pause? Would that be on the table?
Absolutely. We need to do what we need to do in order to make sure we bring inflation down to 2% over the next few years. So if inflation ends up being higher than I expect or stickier, then we'll have to adjust policy appropriately. We've been doing that.
What would it take for you to cut rates?
I think the real issue is if inflation comes down, we're going to need eventually, not soon, if inflation comes down, we'll need to lower the interest rates because otherwise real or inflation adjusted interest rates will go up.
I want to ask you about risks to the economy. A lot of folks are saying commercial real estate could be the next shoe to drop. Of course, we heard that back in 2009 after the financial crisis didn't come to fruition. Nevertheless, what are you seeing? You're here in New York on commercial real estate.
The demand for office space will be changing. I think that does affect the market price of a lot of those buildings, both here in New York, but in other big cities. So that's clearly something that will have to be resolved over time.
Interest rates came in cooler than expected in the wake of the banking crisis. Here to weigh in on what that means for markets as well as for the Fed's next interest rate decision in its upcoming May meeting is RBC Capital Markets Head of Rates Strategy, Blake Gwynn. Blake, great to have you here in studio with us.
Great to be here.
Absolutely. All right, so just into the reading that we got this morning, anything that jumped out to you as a surprise, anything that the Fed should perhaps be lingering on in their own conversations?
Honestly, I think it was pretty in line. I think on the margin, you can find some things that are probably comforting to the Fed. The fact that shelter component did see a decline. But one thing I would point out, I think the component that Powell's been focusing a lot on, this kind of core services ex shelter, that component came down a bit, but it still remains very elevated. So I think as markets, we tend to focus on whether something was a beat or a miss relative to expectations. But I think the Fed takes more of a view of what does this look like over a long trend, where is the level? And I think some of those levels are still quite elevated. So I'm sure it offers some comfort in that we didn't see an increase and we saw decreases in some of these components that they're focused on. But overall, I didn't see this as a big flashing signal to the markets in either direction. It was pretty in line, I think, with what at least we were expecting.
Has the market been too quick to discount continued rate increases after the May meeting, given that inflation isn't really budging that much?
Yeah, I think that's absolutely true. I mean, I think if you look back prior to this banking stress, for 2 or 3 months, we were in a position where the markets had essentially written off the idea that the Fed was going to hike to a higher terminal. That was pretty much the very strong consensus ahead of the banking stress. It's really only since that banking stress broke that markets really started being pulled between these two new themes, which is that the Fed is going to be pulled into this very sharp cutting cycle at some point this year, or on the other hand, that maybe they get to a point and just hold rates for a very long time. And I think most of the price action we've seen has been as the probability shifts from one of those scenarios to the other.
And we've seen price action that has kind of swung
back and forth.
Yeah.
But I think markets have been a little too quick to put a lot of probability on that very sharp cutting scenario where we get a hard landing or we see systemic risk from these banking failures that broadens out into something that's going to force the Fed into deep cuts. And they've also been too quick, I think, to take away any probability on the fact that the Fed may have to keep hiking rates. I don't think today's inflation print was some, a burning sign for them that they have to continue to hike rates to get inflation under control. But I still think they look at things through this risk management lens that says we would rather do too much rather than too little. The banking stress may have changed that calculus a little, but I still think that the majority of the committee is looking at the inflation situation, saying, look, it's still higher than what we want, and we'd rather err on the side of doing too much rather than too little.
Just for clarity as well, I mean, when you say sharp cuts, nothing about sharp cuts at the end of the year sounds like shallow recession at all, or even mild recession.
No, I think really what the balance is right now, I think there's a tendency for markets to kind of look at pricing, particularly in rate space, and say, this is a scenario that's priced in. But really, you may ask 100 people and nobody actually thinks that's what happens. It's actually, you find 20 people that think they're going to cut 500 basis points, and you find a bunch of people that think they're going to stay. And it's that balance, that mix between those probabilities that gives us market pricing. So I think what we're pricing, even though we show a shallow path of cuts, I think really what that's telling you is that markets are putting a 10-20% probability that the Fed has to cut very, very sharply this year. That's either a sharp economic recession, or it could be something purely systemic, banking failures that just start to roll out and cause bigger stress in the system.
So if you don't believe that scenario and you end up being right, then that gives you an opportunity potentially strategically, right?
Absolutely. I mean, I think if you do, at least as I do, think that the risk on this kind of higher terminal that we get to June and there's still a conversation about continuing the hiking process, that certainly leaves opportunities, because I think markets have, if you look at the pricing now, have almost taken June completely off of the table.
Yeah. Blake Gwynn, RBC Capital Markets, Head of Rate Strategy. Thanks so much for joining us here in studio.
Thanks for having me.
Absolutely. Well, CPI data out this morning showing inflation slowing in the month of March. Let's get a check-in on how the DC is reacting with the news today with Heather Boucher, who is the member of the White House Council of Economic Advisors. Heather, great to have you here with us. First, when we think about the administration and the reaction that you're hearing inside the walls of the White House, how are you discussing this? What has been the tone around this report?
Well, certainly we think that this is good news to the extent that the headline inflation fell. It's now at 5%. That's down from 9.1% last summer. This is the 9th month of consistent slowdown in the pace of inflation. So that 5% rate is a slowdown from months before. So that certainly is an indication that things are moving in the right direction. Of course, the president knows and understands that prices remain too high for too many things, but we are interpreting this as movement in the right direction, especially when combined with last Friday's labor market data that continues to show strong, steady, stable growth in the job market, but at a slower pace. So it feels like we're hitting a more sustainable pace there as well.
Even as we hit a more sustainable pace, perhaps, we're still seeing these big year-over-year gains in inflation at the same time that we are seeing wage growth moderating. On the Economic Council, how are you thinking about the issue of affordability for most Americans and how you might be able to address it?
Well, when we look at today's report, a few things popped out. Grocery prices fell. We saw retail gas prices fell, so gas prices at the pump. We saw energy prices fall generally. So those certainly are providing that help to working families across the country. Certainly important ways that giving those families a little bit of breathing room. But that's on top of many other things that the president is focused on to lower the costs facing families. So the push to lower the price of insulin to $35 a month that has been followed up by actions within the private sector to match that. The move to make prescription drugs more affordable, and of course the ongoing work to make energy prices more affordable across the economy. So the president has been focused on keeping prices down. And I think you see some good news in today's report.
And then within, of course, the entirety of the economic situation, we also have to figure out exactly where, as prices begin to abate or at least perhaps normalize, whatever normal looks like in this new normal scenario, what that means for companies and the employment situation as well, because some of the price pass-through to consumers has been on the back of the wages and higher wages that companies are trying to put forth in a more competitive landscape as well.
Well, that's why one of the good things that we saw, that we have been seeing in the labor force reports, has been an increase in people entering the economy, entering that labor force. That's what we want to see to help create that labor supply across the country. So certainly there is some good news there. You know, what we haven't seen is the kind of wage price spiral that I think many people were concerned about because of the challenges of so many people coming back into the labor market after the pandemic. So, you know, I think that there is, let me just pause and note that it has been really challenging to recover from this pandemic economy. And I think you see that in today's report. We're looking for job gains that aren't at that blockbuster pace that they were when we needed to pull out of the depths of the pandemic recession, but they're strong and stable. Of course, we saw all the challenges, supply chains and the unprovoked war in the Ukraine that upended energy prices. We've started to see those signs of abatement. Supply chains are back up and running much more smoothly. We're seeing, you know, prices come down in terms of energy. So this has been a challenging economy. I think reports like today's show how resilient this economy has been, and quite frankly, how effective the president's policies have been at protecting workers and families from some of these challenges.
So Heather, given that, how are you thinking about recession probability at this point? Is it something you're discounting, or where would you put the odds?
Well, you know, the challenge with predicting a recession is that you never quite know exactly when it's going to happen. When you look at the data in the labor market, we are certainly not there. We are creating jobs to the tune of over 340,000 per month over the past 3 months, so that on average. So that certainly is not recession levels. You know, we're seeing some uptick in unemployment insurance claims, but certainly not at the kinds of levels that we typically see during a recession. We are seeing high prices, but as we're noting today, the headline price, did drop by a percentage point relative to last month, year over year. So that is moving in the right direction. Honestly, one of the biggest things that I'm concerned about looking forward is whether or not Congress will do its part and raise the debt ceiling limit. This certainly could cause chaos across the economy. It could upend the strength of this recovery. So that's, as I'm looking forward and wondering about a recession, what I want to know is whether or not we will see Congress vote, as they have so many times before, for a clean debt limit, because I think that would reduce that probability considerably.
Yeah, definitely, and it's something the markets are watching very closely as well. Heather, thanks for your time this morning. I know it must be a busy one. Heather Boucher, White House Council of Economic Advisors member. Thank you.
Thank you.
Well, drug makers have been blasting a Texas court's recent ban on an abortion pill, saying the ruling could hinder the development of new medicines. Yahoo Finance's Anjali Kamlani joins us now with more.
That's right, Julie. So a lot of these major companies have been signing on to a letter, as well as have joined an amicus brief that would support the maker of mifepristone in this Texas ruling. And we know, of course, the government has also filed an appeal. So this just adds to what we know is an ongoing fight. I want to point out that in this letter, the companies have taken a pretty strong stance on the issue, saying specifically, quote, that the judge's decision is basically interfering with the FDA's authority and setting a precedent to diminish that over drug approvals, and in doing so creates uncertainty for the entire biopharma history. So here to join me with more on that is one of the signers and the leader of the letter blasting the decision, Jeremy Levin, Ovid Therapeutics CEO. Jeremy, thank you so much for joining us today.
Good morning. Thank you for having me on.
So tell us about this letter. As I understand it, you started it with a couple of others and made some calls to some of the big pharma companies to get them to sign on as well. What are you hoping the impact will be?
We started this some time ago. We watched the case being filed. We actually thought it would never go anywhere originally. And then as it got momentum in the court, we felt we had to take action. Last Friday, we drafted the letter, finalized it, and then the handful of us circulated it very quickly. The point was that within hours, hundreds, now well in excess of 500 people have signed on. These are the leaders across the industry, the people who generate medicines, actually not just for America, but right around the world. The bottom line is, if we do not stop this, what will happen is you've opened the door to a complete abrogation of the mandate that Congress has given to the FDA. The FDA is the only body with medical and scientific capability for assessing new medicines. We can't hand that to a court, a single judge. And that if we do that, we upend the entire process for developing medicines, vaccines, devices.
So wouldn't you, what isn't the industry already kind of used to being a part of the legal system? You know, people sue against impacts of drugs all the time. We've seen a lot of controversy, like in the case of Aduhelm, you know, the pushback from the public as well as the regulatory body itself. So why would this be any different?
This is completely different. At its core, this judge has challenged the approval of a drug with decades and decades of safety. That safety it was approved appropriately by the FDA. Then we have decades of safety data showing that it's effective and has actually been very instrumental in saving the lives of individuals. Now, there are many other drugs like this, hundreds to be perfectly honest. That said, if now a politically motivated group can now sue with an individual judge and overturn decades of scientific and medical evidence without having any of that experience, no medical experience, no scientific experience, you throw into question the entire ability to approve a drug appropriately. So this is different. When drugs cause side effects, yes, you can absolutely challenge the companies. That's totally correct. This is different. They're challenging the approval of this drug, which was medically and scientifically evaluated and its safety proven over years.
And when we're talking about taking this stance with the companies that you've been able to rope in, when it comes to the stance politically, it seems like this is where the companies are starting to go to be able to respond to political pushback. Do you think that this is sort of the new trend? Is this what we're going to start seeing?
Well, to be fair, companies have stakeholders. They're patients, they're investors, they're shareholders. They are every component of our society. And those are also the voters. So it can no longer be the case that a company can simply say, well, I'm just going to look for shareholder value. They have to be part of this ecosystem, which includes the policymakers. So yes, companies must pay attention to what policymakers are doing. And when you have a critical step like this by an errant judge who suddenly decides to take on a system, you really must step forward, because if you don't do that, you threaten the health of the nation, you threaten the ability to find new medicines, new drugs, new vaccines, and actually you put at question the entire leadership that America has as the premier source of innovation in medicines in the world. The FDA is the gold standard. Everybody in the world uses it. That is the standard we, you, I, and millions of other people who take a medicine rely on. Now you've got one person in a court somewhere saying, without medical or scientific evidence, saying, we're not having that any longer. How can that be?
I know that we've got a bunch of the House and Senate Democrats signed on as well to this amicus brief. Are you hoping that they might take a step as well in looking at proposals for bills and the like?
Well, this is really a bipartisan issue. This is not left or right. This is not male or female. This is about, do Americans want to have safe and effective medicines? And do we believe in the mandate that Congress has been given to the FDA to be the sole arbiter of such? If we do that, then in fact, it's really not a question of whether the Democrats or the Republicans do anything. Incidentally, of the hundreds and hundreds of signatories that have come in from leaders across the industry, there are Democrats, there are Republicans, there are highly religious people, there are secular people. This is not a question of any one side. We're all in this together. This threatens the health of America.
And then a final point on the FDA's authority and the impact on the industry. I know a lot of the companies and leaders have said that this could really impact the potential for new drugs to come to market and innovation. And I wonder, we've heard that before, especially when there was pressure on drug pricing. So it seems like there's a lot of concern within the industry right now about many external factors that could put pressure on innovation. What would you say to the idea that this is, inherently risky as a business anyway?
No, this is completely different. In our business, you have a large number of risks you have to take: biological, medical, regulatory. But they're all risks that our industry understands. And then finally, when you get the medicine into the marketplace, you understand that you have to take it to patients, and there's a price that has to be paid for that. And certainly Congress and the industry debate over how you handle those prices. This is different. This is saying, you know what? We have a drug. You think you've got a drug. It's been approved. Now we're going to say it's not a drug. How can you have any predictability in our industry when you have now the likelihood, if this is successful, of a legal challenge of the already extremely thoughtful and deeply arduous approach to finding new medicines? If you're now going to have a single court in any part of the country can now challenge that, you upend the very basis of whereby innovation is driven. Some form of fundamental medical and scientific evaluation of that medicine has to be taken. The FDA is the right place for it. Congress has mandated that. And without that, it's a completely different system. America will lose its place in the world as a primary producer of medicines.
Certainly something we'll all be watching play out, as I know you will. Jeremy Levin, Ovid Therapeutics CEO, thank you so much.
Thank you very much.
And thank you, Anjali, for bringing us that important conversation. Appreciate it. Stay tuned right here for Yahoo Finance. We've got some big interviews on tap all day here. Rochelle Akufo in the next hour is going to speak with Dr. Doom, as he is frequently referred to, Nouriel Roubini, on his big picture outlook for the economy and his mega threats he's been warning about.
I've been speaking about mega threats, not just economic, monetary, financial, also political, geopolitical, environmental, health, technological, deglobalization. And now this buzzword of polycrisis, the same idea as mega threat, is one that everybody's using.
And we're taking off into earnings season tomorrow with Delta Airlines on tap before the bell. I'll speak with Delta Airlines CEO Ed Bastian for a reaction to those numbers. You do not want to miss that.
Plus, from new homeowners to new parents, we'll continue our ultimate tax guide breakdown with an expert on filing as a first-timer. Let's take a check on markets before we leave you here, because we are seeing stocks really give up some of their earlier gains, and the S&P and the Nasdaq, Brad, are now in the red.
Yeah, biggest changes right now. Consumer discretionary to the downside, down 0.6%. Real estate, though, putting the team on its back. It's up by about 0.75%. Overall, mixed right now for the sectors.
All right, have a great day, everybody. Rochelle's up next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Still sticky. Headline inflation is showing signs of cooling, but will it change the Fed's trajectory? A stubbornly high core reading might be enough reason to push back on all that rate cut talk. And stocks like what they see. Now attention turns to the next catalyst for investors. Fed Minutes this afternoon will give us some sense of the Fed's mindset in the aftermath of SVB's collapse. And we'll talk storm clouds with Dr. Doom himself, Nouriel Roubini. He's known for predicting the credit crash of 2007 and now says the US is heading for a stagflationary debt crisis. You don't want to miss it. But first, let's check in on how the major indices are faring. After that inflation data came in for March, we did see markets here turning mixed. As we see the Dow there, the only one just barely in positive territory, up just barely though, about 15 points. The S&P and the Nasdaq currently near session lows at the moment. The S&P there losing just about 3 points. The Nasdaq taking the biggest hit so far, down still just about 45 points. Let's also check in on the Treasury market to see how that's impacting the yields there as well. We see the 5-year there down, as we can see, about 1.3% there, so seeing some flight to safety for these short-term yields. The 10-year down just slightly, about 1/3%. The longer-term 30-year yield seeing gains there, 0.69%. Right, well, turning now to our top story, cooling inflation, raising hopes the Fed could hold or even bring down rates. That optimism shared by Gary Cohn, former NEC director, who says the worst of the trouble with the banks may already be behind us. Take a listen.
We're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis.
Our next guest, however, says increased spending, the fallout from recent bank collapses, and yes, still high inflation are creating storm clouds on the horizon. Joining us now, Nouriel Roubini, Stern School of Business, New York University Professor Emeritus. Thank you for joining me this morning. So I first want to get your reaction to where we are in this banking crisis and the repercussions.
I think the worst is still ahead of us. The business model of many regional banks is broken. They have a narrow deposit base. They have a large amount of uninsured deposits. They had massive losses on their securities. Even the value of their loans is falling. They have exposure to commercial real estate. And many of them, if you measure it correctly, given the changes in interest rates, are now insolvent. If they have to raise money, not at 50 basis points on their deposits, because people can get 4 or 5% on safe money market T-bills, then you have a problem in terms of cost of funding and value of their assets. So I think that the worst in terms of severe banking stresses is still ahead of us. And of course, this credit crunch is going to reduce significantly economic growth. They lend to SMEs, they lend to households, they lend to commercial and residential real estate. That credit crunch is going to tip the US economy into a recession later this year.
And I mean, we still don't know exactly how long these repercussions will last, but some not quite as pessimistic. In Jamie Dimon's annual shareholder letter, he noted that there would still be repercussions from the banking crisis for years to come. It does raise recession risks, but he said nothing like what we saw in 2008 because it involves far fewer financial players and fewer issues that need to be resolved. Is there something missing there from this picture?
Well, compared to 2008, now we have inflation. At that time, we didn't have inflation. We have had a number of negative aggregate supply shocks that reduce economic growth and increase the cost of production. So at that time, we had a demand shock, a credit crunch, deflation. We could do massive monetary, fiscal, and credit easing. Now entering economic contraction when inflation is too high and the Fed has to keep on hiking. Even before these banking stresses, the Fed was facing a dilemma because either you raise rates to fight inflation and you cause a recession, or if you care about job growth and you don't raise rates enough, then you have a de-anchored expectation. Now the dilemma has become a trilemma. In addition to price stability, maintaining growth, we also need financial stability. And as you raise rates, you create more stresses for both creditors and for borrowers. And therefore, you have only one policy instrument, in this case, the Fed funds rate, to hit 3 targets: price stability, growth, and financial stability. To me, that looks like mission impossible.
And you mentioned this trilemma there. So you have the looming insolvency crisis, recession risks, inflation as well. But you also do have a much stronger consumer now than you did in 2008. But you say that a doom loop is coming. Is it not avoidable then?
Well, among the households, there are those who are doing better off, but the bottom 50% of the household sector lives from paycheck to paycheck. The average household has only a few $100s of liquid cash spared. That's savings during COVID, but they spent a lot of it. Real wages have been falling because wages were growing less than inflation. And there is some meaningful amount of financial fragility. Anybody who has a consumer loan, a credit card, an auto loan, student loan, or mortgage at a variable rate now is facing much higher debt servicing costs. So we're starting to see the buildup of fragilities for at least half of the household sector as well.
So what can central banks do at this point? I mean, we saw the IMF raising risks as well about even the vulnerabilities of non-bank financial institutions as well, and talking about how much the global financial stability hinges on that as well. What can central banks do?
Well, right now they're in a trap because either they raise rates even more, and even today's inflation report suggests that core inflation is still at 5.6%, well above 2%. If you raise more in order to fight inflation, you cause an economic downturn. This is going to lead to more non-performing loans and more financial stresses. And more financial stresses in financial markets, banks and non-banks, are going to imply a more severe economic downturn, so economic and financial crash. Or if you care about growth and about maintaining financial stability, you stop raising rates when inflation is still too high. And then over time, you get a de-anchoring of inflation and inflation expectation, and you get a wage price spiral. And then you end up like the 70s with inflation remaining high, eventually recession. But in the 70s, we had stagflationary shock, but debt ratio were low, 100% of GDP, private and public. Today, there are 420% of GDP. After the GFC, we had a debt problem, household, housing, mortgages, banks, but we had a negative demand shock that was deflationary. Today, we have the worst of the 70s in terms of negative supply shocks and debt ratios that are significantly higher than they were even during the global financial crisis. That's why I do worry there's going to be a great stagflationary debt and financial instability. We're the worst of the 70s and the worst of the post-GFC periods.
And some of these other mega threats that you mentioned, what we're seeing in terms of countries engaged in what you call various wars, some real, some metaphorical, and talk about the domino effects on that and what that might mean for investors.
Well, we are in a geopolitical depression. There is already a hot war with the brutal Russian invasion of Ukraine. This spring, this war is going to get worse, potentially further shocking commodity markets. I was recently in Israel, where it's clear that Iran has become a threshold nuclear state. If Israel were to attack Iran, you'll have a spike in oil prices worse than 73 or 79. And I just visited China, where unfortunately the Cold War between US and China is getting colder by the day. And this geopolitical depression is leading to a fragmentation of the global economy, decoupling, protectionism, deglobalization, balkanization of global supply chain. We've gone from free trade to secure trade, from offshoring to friendshoring, from just-in-time global supply chains to just-in-case, and from caring about economic efficiency to talk about economic and geopolitical security. These things are costly. They reduce global growth, they increase cost of production, and there are forces that, among others, are stagflationary for the real economy.
And I mean, we're seeing countries having to take sides as both China and the US trying to push forward with technological advancements. But obviously, the US dollar is still the predominant global currency, reserve currency. But as people do sort of take sides in this dynamic, what lies ahead then for the dollar and the multinational companies that are essentially stuck in the middle here?
Well, we had until now a unipolar global reserve currency where the dollar was dominant, but it's clear that China and its allies, revisionist powers like Russia, like North Korea, Iran, Pakistan, and others want to build an alternative global monetary and reserve currency system because they worry that the kind of sanction we imposed on Russia, if there was a conflict or escalation over, say, Taiwan, could be imposed on China. And China has over $1 trillion of reserves that are in dollar. So they need to have a unit of account a means of payment, a store of value that is alternative to the US dollar. And they're going to start to build it and already talking not only to their own allies, but also other friends that do business like those in the Persian Gulf about pricing oil in RMB, paying it in RMB, and building reserves in RMB. That's going to take time, but I think that gradually over time, we're going to have a process of a movement of a unipolar global reserve currency system to a bipolar, where you're going to have US, Europe, the West based still on the dollar, but then the Chinese are going to build the RMB as an alternative to US dollar. That means less financing of our own twin fiscal and current account deficits when we still have very large stocks of private and public debt that can push higher the cost of financing for the United States when we have very high private and public debt ratios.
So a lot of dynamics and nuances at play in this relationship investors should be aware of. Nouriel Roubini there, Stern School of Business, New York University Professor Emeritus. Thank you for joining us on Yahoo Finance today.
Great being with you today.
Thank you. All right, now for our trending ticker. Investors lowering the altitude of American Airlines on the airline's updated profit outlook. The airline releasing updated earnings expectations for later this month that are coming short of analyst expectations, with adjusted earnings per share between 1 to 5 cents versus expectations of 5 cents per share based on Bloomberg consensus. Airlines like American, of course, particularly exposed to movements in the energy sector as the peak summer travel season looms. We see that the stock down almost about 9.5% on the day. Right, coming up, the new guy at the Fed causing a stir. Austin Goolsbee says the central bank needs to be cautious going forward and hints at the elephant in the room. We'll tell you what that is next. Chicago Fed President Austin Goolsbee out with dovish comments calling for caution on monetary policy amid credit uncertainty. Here with the details is Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Hey there, Rochelle. Good morning. Chicago Fed President Austin Goolsbee hinted at the desire Tuesday to not raise rates at the May policy meeting. The voting member said in light of Silicon Valley Bank's failure and moments of financial stress, the right policy approach calls for prudence and patience to assess the potential impact on the economy. He said in a speech, quote, "Given how uncertainty abounds about where these financial headwinds are going, I think we need to be cautious. He said we should gather further data and be careful about raising rates too aggressively until we see how much work the headwinds are going to do for us in getting down inflation. Now, in contrast, New York Fed President John Williams told me in an exclusive interview Tuesday that he's watching credit conditions closely, but doesn't see broader impacts so far on consumer and business spending in other parts of the economy, though he added it's still early days. Meanwhile, Minneapolis Fed President Neil Kashkari said the Fed's interest rate hikes and a possible pullback in lending following those bank failures could trigger a recession, but allowing inflation to stay high would be even worse for the job market. And we're just hearing from Richmond Fed President Tom Barkin moments ago, who spoke with CNBC, saying we don't want to declare victory prematurely on inflation. He says we haven't seen evidence inflation has cracked yet. So, Rochelle, clearly a divide between members of the Fed who want to go cautious in the camp of Goolsbee versus your Barkins, Williams, and Kashkaris, who still want to fight ahead on inflation and perhaps see these reverberations from bank failures contained at the moment.
I mean, it's tough. Investors probably scratching their heads at the moment, trying to figure out who to follow then. And of course, Jen, the Fed minutes also set to be released later today. What would be the most interesting aspect of these minutes this time around?
So, Rochelle, as you know, the Fed minutes are released with a 3-week lag, but we're going to get a window into what the Fed was thinking when they decided to hike rates on the back of Silicon Valley Bank's failure. If you recall, that decision was down to the wire, and it followed very strong reports on both the job and inflation fronts. So we'll get some thinking into what Fed officials were thinking then. However, that was 3 weeks ago, and conditions have changed, so investors need to take those thoughts with a grain of salt.
Certainly closely watched. We'll have to pass through that wording indeed. Jennifer Schonberger, thank you for that update.
Thanks.
Well, the latest inflation print showed U.S. consumer price gains cooled in March, while core inflation still remains far above the Fed's target. Here with more on the latest reaction to the recent inflation data is Ben Amond, New Edge Wealth Senior Portfolio Manager. Good to see you, Ben. So, trying to make sense of this all, obviously we're getting a lot of Fed speak and then this CPI print. What are your takeaways from this?
Hi, Rochelle. Well, as Goolsbee puts out in his speech, and I think that's a significant speech, that yes, inflation fight cannot really end yet, but they have to really bring into their focus the stress that's built up in the banking system, because as they raise rates, ultimately this did lead to a fallout in the banking system, and as that then now starts to spill over to the real economy, eventually it will affect inflation too. So this data we just got this morning shows still stickiness, as we say. There's shelter inflation, and there's other components that are very elevated, but there's energy on the other hand that's declining. At the same time, we're dealing with a credit problem potentially, and that's, I think, what the focus will be for the Fed today. What we'll get out of these minutes is that this will become a factor going forward from here in the decision making. So I think the way the market reacted was to take some of the expectations of June and May back for a rate hike and be a bit more cautious here, as the Fed may be going towards one more rate hike and then end the cycle.
And so what are your expectations here then? Do you think investors are going to finally catch on to that? Because obviously they seem to have been going in a different direction, sort of fighting the Fed up until this point.
Yeah, that divergence between the Fed and the markets is on the one hand really about the markets looking much more further ahead in the future of Fed, you're raising rates quick and fast, and it does damage to the economy. So it will result in a recession, and therefore we discount lower rates. Whereas the Fed is more current data and looks at data point by data point right in front of the meeting as that where it is down to the wire, and then make its decision last minute to say, okay, we're going to raise rates or we're not. And so this is why we're having a gap between the markets and the Fed. And I think that gap will probably persist for a while, because this Fed, as you just heard from your colleague, like say Barkin, again, coming with a very different opinion about the credit crunch that Goolsbee sees as a bigger risk, shows that the vibe within the Fed probably leads to consensus to stay the course on we have to bring inflation really down to be sure. So I think that gap between the Fed and the markets will persist.
And Ben, to that point, earlier this week, Yahoo Finance had the chance to speak with New York Fed President John Williams, and we were able to get his thoughts on the Fed's restrictive policy. Take a listen.
I would say we're somewhat restrictive. I mean, I would get out my thesaurus maybe and come up with a more creative word, but I think somewhat restrictive. My view of kind of the longer run neutral real interest rate is about 0.5 percentage point. So I think we're somewhat above that. So the real question to me is, we've gotten to restrictive. What's it going to take to be sufficiently restrictive? Do we need to do somewhat more to get there? And obviously be driven by kind of the data and the outlook.
Now, Williams mentions the neutral interest rate. I wanted you to first break down what this means and why this rate is important for the Fed.
Yeah, the neutral rate of interest is about an interest rate where the economy is not growing really fast or really slow, where things are not too hot or too cold. It's just about right. And clearly, we're not in that economy just yet, right? We're actually an economy with too high inflation and too low employment. And so what he's pointing at is that if you take the Fed funds rate and you account it for inflation, it is just above what he thinks is neutral, but it may have to go a bit higher from here in order to get this better balance between employment and inflation. So neutral to the Fed is really about, we want to get back to an economy where things are much more in balance. They're getting there, but as you can tell from the inflation data, we still have a lot of sticky parts in there, which indicates they have to do more work, which, as William said, they probably have to bring up their rate a bit more into restrictive territory and then getting an economy that's better balanced. And that should reflect ultimately a neutral rate, which to the Fed's estimates is something like 2.5%. So eventually the Fed will go back to that rate. Just at this moment, they have to be more restrictive and have a funds rate far above that 2.5%.
So then how are we figuring out then how low or high that neutral rate is supposed to be?
Big academic debate, Rochelle. I'm here in Washington myself, and at the IMF there's a big paper out now that they think these neutral rates are very all over the place, if you will. But if anything, they probably have declined again, because as much as we did to help the economy get over COVID and did a lot of stimulus, it's all been very temporarily. So the potential growth rate of the economy hasn't changed much. If anything, maybe has gone down because there's not been enough investment. People have been sidelined. Productivity has declined. And so the IMF is a very interesting point there, saying if you have a lower neutral rate and you're going to continue to raise rates, then you will end up eventually with having to go back all the way to zero because you've done too much damage to the economy. So I think this neutral rate is somewhat variable. I think, though, from my own analysis, that the neutral rate probably is somewhere where the Fed thinks it is, 2.5 to 3%. And that's also what financial markets are discounting. So that means the Fed can still raise rates somewhat, but we're probably ending the tightening cycle sometime in the next quarter.
Certainly a delicate balancing act when you factor that in as well. Yeah. Ben Amons, New Edge Wealth Senior Portfolio Manager, always great to have you. Thank you for your time.
Thank you.
All right, coming up, reaping the rewards. Is still elevated inflation driving consumers to seek discounts online? We'll ask a leading e-commerce business how retailers are doing in this environment. That's next. While investors await Friday's retail sales report for a temperature check on consumer spending, Rakuten, in collaboration with Vogue Business, has released survey data from 1,200 Vogue and GQ readers to gain an understanding of today's luxury buyers and how current economic conditions are shaping their behavior. Here to discuss is Rakuten Rewards President Kristen Gold. Kristen, thank you for joining me this morning. So, as we're taking a look at what's been happening with inflation, how are you seeing that showing up in Rakuten's data?
The interesting thing is, from a consumer spending perspective and from a spending perspective overall in retail, we've seen relatively positive momentum in the first part of this year, and that aligns with the data that we've seen coming out about consumer spending in the larger market. What this means is that people have jobs, they still have pandemic savings accounts, and ineffably what that means is that consumer spending will continue to remain relatively positive despite the fact that everyone is nervous about the economy. We're seeing that really render itself well in luxury. Now, remember, luxury overall for the last couple of years has been a freight train. And this continues to be something that as consumers decide how to spend, some of them are being a little bit more elevated about how they're spending their money, meaning they may be spending a little bit less on some of the things that don't matter to them, but they are still investing in luxury goods, which is why luxury is growing at the rate that it continues to.
Now, I was shocked looking at Gen Z's growth when it comes to luxury spending. Talk about the differences we're seeing generationally and why Gen Z, as we see here, their spending growing 3 times faster than other generations.
This was the craziest data of all to me as we were digesting this. So the thing about Gen Z is that they are starting to buy luxury significantly earlier than the generations before them. Gen Z starts buying luxury on average at 15 years old. If you look at Gen X and Gen Y, they purchased luxury at 22, 23, 25 was the first time that they sort of entered the luxury market. So Gen Z, because of how they've grown up digitally, they're very aware of luxury. They're also very aware of sustainability in purchasing, which means that they will buy fewer things, but they will buy better things. And for them, that may mean not buying 5 handbags, but buying 1 luxury handbag. And it's a very, very different mentality, both because they've been exposed to luxury from a very early age when previous generations weren't, but also they want to buy less, but buy better.
And I mean, they most of them, from what we can see from the study, have the luxury of still living at home, so don't have some of the costs the rest of us have with things like rents and mortgage. But they don't also seem to be rushing to change any of this. I mean, 15 years old seems incredibly young. How is that shaping how some of these advertisers are really approaching some of these buyers then?
I think from a luxury advertiser perspective, they're going to have to change how they reach people, where they reach people. It used to be that you would only be able to access luxury by going into a luxury store, either a department store or a boutique. Luxury brands during the pandemic moved online. They moved a little bit more to digital, but the access to luxury is going to be very important for these younger generations. The way that a lot of these younger generations started to work with luxury was resale and looking into sites like The RealReal and Tradesy and ThredUp. And what that allowed luxury brands to do is gain a lot of exposure with this audience. But what these luxury brands want is they want a conversation with that audience directly. It means that they're going to have to be in different digital channels. Chanel needs to be on TikTok. It's a very different paradigm from, I think, where they were 5 years ago even.
I mean, it really is. And I want to also talk about how people are funding their purchases, the growth of credit cards, buy now, pay later, and incentives. Where are you seeing the strongest growth in how some of these purchases are being funded?
The interesting thing that we saw, I assumed that all of this would be funded with credit and funded with buy now, pay later. But when we looked at our data, increasingly, it's really being funded with personal income. I think your point about how younger consumers are more often living at home. They have a lot of, discretionary income, especially Gen Z. So they're using this discretionary income to fund these purchases. But increasingly, it is about how do I save money and how do I sort of gain, money back from companies like Rakuten, which is how do I get cash back on the purchases that I make. And then also, they are using buy now, pay later. They are using credit, but not to the extent that we actually thought that they were.
And so as we look at the average unit price, when you do have a bigger pool of people coming into this luxury market, how is that changing pricing?
So our average order value has gone up, really consistently over the last few years at Rakuten because specifically the luxury vertical has been driving it. So what it means is that what we're seeing is that consumers are buying fewer units overall. So they are buying less frequently, but when they buy, they are spending more. This is a very conscious consumer pattern. It's really interesting that the average order value continues to be sort of what's driving the market. Partially that's inflation, right? We know that prices went up, and we know that in luxury in particular, price increases were a huge thing over the last few years as luxury really tried to level set how they build their brands and at what price point they want to play. But there is this shift in average order value overall that really points to the fact that people are being very conscious about how they're spending their money and how many times they're purchasing.
So the more conscious consumer, an interesting trend to watch. Great stuff there. Rakuten Rewards President Kristen Gold, thank you for joining me this morning.
Thank you.
All right, coming up, want to turn a buck? Get onto ChatGPT. Its owner, OpenAI, will pay people to report on any vulnerabilities in the system. Find out just how high the rewards are next. Bug bounty. OpenAI hoping to hedge its new generative AI technology against future problems by offering to pay coders to discover any bugs in its systems. Now, some of the criteria might surprise you. Yahoo Finance's Ali Garfinkel has the details. Ali, what are you watching?
Hi, Rochelle. So you said it. This program is called OpenAI's Bug Bounty Program, and it's being run in conjunction with a company called BugCrowd, which is a crowdsourced platform that allows ethical hackers to identify and submit vulnerabilities in systems. Now, for OpenAI, they're willing to pay up for this, right? For hackers who find bugs, that are low severity, it can be $200, but for really exceptional finds, really big vulnerabilities that are kind of unearthed, the payout can be as much as $20,000. And people are already taking OpenAI up on this, right? This was just launched yesterday, and 14 vulnerabilities have already been reported and rewarded in the system. Now, the turnaround time you just saw is pretty fast. Most of the claims are turned around in about 3 hours. And the average payout has been more than $1,000. So it's not the 20,000 of your dreams, but it certainly is a hefty price tag. And, for me, bottom line, the way I interpret this is that OpenAI is pulling absolutely every lever it can to build trust in ChatGPT and its other products.
Well, you know, even $1,000, nothing to sneeze at in this economy. But Ali, talk about why this is something that OpenAI would want to invest this kind of time into.
It's a great question, Rochelle. And I think it comes down to the fact that the stakes are really high here, both societally and monetarily, right? As the AI hype cycle has grown, so has the backlash, right? We've seen even vaunted tech CEOs and figures, from Steve Wozniak to Elon Musk, say, wow, we need to slow this down. But the reality is you sort of can't stop the pull of ChatGPT. The ChatGPT's iPhone moment came, and it's hard to back away from. Remember, in January, ChatGPT became the fastest growing consumer app in history. It hit 100 million users just a few months after its launch. And I was actually looking at a PwC statistic. By 2030, I believe about 15 trillion will be contributed to the economy globally by AI. So I'd say, why would OpenAI do this? The reality is, medium term and long term, there's a lot of money on the table, and they have every incentive to build as much trust as humanly possible, especially in this moment.
And it's interesting because one of the ways you can also get money is trying to basically trick the OpenAI into writing malicious code. How does that work? And should we be so invested in AI when there are still so many bugs still being worked out, but you have big tech rushing in at this point?
Yeah, and I think everybody's rushing. Well, it's part of the tech ethos, right, Rochelle? Nobody wants to miss out. Nobody wants to be the last one in. But I will say, as I was having used ChatGPT quite a lot, I do actually find some of these bugs pretty difficult to find. And I actually do find some comfort in ChatGPT's case, especially, that a lot of these bugs we've seen so far, the payouts are relatively low, right? If the scale is 200 to 20,000, it seems like there are some substantial bugs, but nothing has been unearthed immediately that says, oh, we actually have a really big problem here. So I would say, yes, there certainly are things to be concerned about. However, these numbers don't look as bad as I was expecting, to be completely frank. I'd say if you're out there and you're saying, how much should I trust ChatGPT? The answer is, for direct information, not at all. It only goes up to, I believe, 2021 with a couple of small exceptions. But I definitely do find some comfort in the fact that OpenAI is making it available and is really going out there saying, hey, we want you to find these bugs. And I think if they weren't doing that, that might be even more concerning.
No, that's a fair point. We'll have to keep a lookout and see if we see any of those $20,000 bounty problems coming up. Ali Garfinkel, thank you for that update. All right, coming up, calling all first-time homeowners, new parents, and newlyweds. Remember, your tax situation might look a bit different this year. Find out why and what you can do about it next. If your tax situation looks a bit different this year, perhaps a bigger family, new home, new spouse, we've got you covered with Yahoo Finance's Ultimate Tax Guide. Let's go to Yahoo Finance's Brad Smith. Hey, Brad.
Hey, what's going on, Rochelle? Well, so you're a new homeowner perhaps out there watching. You got a swanky new setup. You got the little garden gnome outside. You've got something on the inside to the tune of a new swanky couch in your new place. But remember that new property, of course, means big changes for your taxes this year. And so we're going to break that all down. Mark Stieber, who is the Jackson Hewitt Chief Tax Officer, he's got all the answers for you that you need to know. Mark, a lot of people are in a crunch right now. And for new homeowners out there, the first-time homeowners, what do they need to know?
Well, I'm often asked, my tax return is so simple, can I do it myself? And I said, maybe, possibly, probably not. But there are a few things to watch for in life. Life changes drive tax changes. And the single biggest life change that drives the most tax changes, and we'll talk about them in a moment, is purchasing a home. Maybe not the first year, because it depends on when you buy the home, early part in the year, latter part of the year. A lot of those items might not make it through to your tax return. Mortgage interest, property taxes, points on your mortgage, refinancing, a lot of other things that go into it. But once you're a homeowner, there is no question, it's unequivocally clear you are no longer a simple tax return. Maybe not that first year again, but after the second year, when you've got a full year of home payments, full year of property tax assessments, a full year of all the other things that go with being a homeowner, home improvements, line of credit, equity line, those make your tax return complicated. You glaze over that and put that to the side and just say it's like last year and I'll just do it on the simple, easy form of the standard deduction, you're throwing money away. There are a lot of tax benefits that go to a tax return. They start with what I call the anchor tenant, buying a home.
Buying a home. Okay, so what if I already had a home though? What if I renovate that house? What if I'm acting brand new out here and just trying to make sure that I've got that new experience that I've updated my house with? What if I've made those renovations to the home?
Well, renovations in and of themselves are not tax deductible.
Okay.
That's not a tax break like charitable donations or property taxes.
It's changed the value of the home, though.
It changes the value, and more importantly, it changes the basis, because at some point you may sell that house.
Yes.
And if you have gain under the United States tax law, you might have taxable gain. Now, there's a lot of rules way beyond the scope of this conversation, and a large portion of it's tax exempt now under some recent changes. But you do need to know the basis of your home so you can calculate the accurate gain, so you can determine whether or not that it is a taxable gain or exempt gain. Now, there are also sales tax associated with a lot of that, and that goes back into that bucket of what do I need to keep track of? Well, your mortgage interest is one of them. Clearly, that's deductible. Property tax is the second one. Most people who have a home with equity, line of credit, interest is tax deductible, potentially. Then once you're an itemizer versus a standard deductor on a tax return, you get to add a bunch of other things like charitable donations, medical expenses, and other things that you can add on to your deductions for a tax return. But it all starts with that large mortgage interest deduction piled on with property taxes. And if you're in some of the high northeastern states, that can add up pretty quickly. Because under the United States system, you get one of two deductions. Everybody gets a standard deduction, depending on your marital status. If you're single, it's about $12,000. If you're unmarried with a dependent, it's about $18,000. If you're married, you've got about $24,000. You get that. Right. Now, if you have itemized deductions, mortgage interest, property taxes, sales taxes, medical, charitable donations, you get the bigger of the two.
Oh, wow.
And so if you don't own a home, you're probably in the standard deduction category. Yeah. But as I said when we started, once you move into the I own a home, mortgage interest and all those others pile up pretty quick. So it's in your best interest to understand what the rules are, what you need to capture, and then throw all that on your tax return and get the biggest refund that you can.
Now, say for instance, because we got a lot of people that Airbnb a home that they do own as well. How does that change the calculus, the filing for taxes as well?
Well, when you own rental property, which is what an Airbnb is, you're technically self-employed. You've got a small business now, and there's a whole host of rules that go with that. The starting of which is if you got income, unless it's a de minimis, and there's a special 14-day rule. If you don't rent more than 14 days, there's a great loophole that says you can just ignore that. You just keep that money, put it in your bank account. You don't have to tell anybody about it.
Done.
14 days.
Okay.
Go past the 14 days rule. You're just like, call it any big realtor that owns big malls or any big building.
I'm Brookfield at that point.
You're a big realtor, but on a smaller scale. Okay. So you get to take things after you include your income that are deductible. to your point earlier, you get to take depreciation or cost recovery of the home that is rented. You get to take business expenses. Say you have a cleaning service, an extermination service. Say you have all the other things that go with owning and maintaining a property. Those can be tax deductible related to your Airbnb. You shortcut the deductions, where I see most people make a mistake, and you just include the income, you pay too much in tax, and that's just not right. And the IRS is not going to catch that for you. They'll catch it if you leave off the income, but they won't catch that you have all these deductions, travel expense, maintenance, repairs, all the other things that go with owning a home, tax deductible, which will offset that income.
I want to switch gears here because I got to kind of hustle to my finish. Yep. But let's talk about those who have some new nuptials out there, the newlyweds, the happy couples that have gotten married. How does that impact their taxes?
Well, you pick these great in order. Did I give you these? I'm not even sure how you got these. But second from the buying of the home, the single largest tax impact on a tax return is getting married or getting divorced. Because when you're getting married, it's not as simple as 1 + 1 is 2. It can be 1 + 1 is 3, because you have two sets of income that can be added together. You may very well be in a higher bracket than you were as singles, or you may marry someone who just likes owing every year, and you're happy with that $10,000 refund that you get every year. You file your first married tax return, your refund's gone. Well, maybe your spouse is one of those pay late people. And that refund shock, or worse, balance due trauma, is something that I see right after everybody gets married. So if you're planning to get married, sit down with your tax pro, or just sit down yourself and kind of walk through what it's going to look like so you don't have the post-nuptial shock. Because when you get married, everything changes. You embrace and absorb not just your spouse for life and their family history and in-laws, you absorb their tax history, good and bad. So if you've married someone that's got tax skeletons in the closet, you own that too. So it's good to do your little bit of homework and find out what your tax refund situation is going to be looking like, what your tax due situation might be looking like, and avoid any tax shock trauma from getting married.
The only mention of skeletons that I like is the song by Stevie Wonder. So Mark, just as we're speeding along here, what if you got a divorce on the other side of that?
Divorce is an equally huge change in your tax filing status, and a lot of things change depending on a lot of factors. Do both people work? Does one person work? Do they get alimony? Do they get child support? All which can have dramatic tax changes, and also which can have some changes that were not the old rules that you might have thought existed 5 and 6 years ago. So there are changes to what those rules are on child support, alimony being chief among them, no longer deductible by the payer. But getting a divorce has a traumatic difference in tax results year before, year after. So you certainly want to talk with a tax pro and kind of find out where you are. And I'll even say this, you don't want to wait to tax day on any of this. You don't want to be sitting there at midnight with your tax pro going, all right, we got married and bought a house and got divorced last year before I got married. That will lead to some big surprise when you're sitting there. Do a mid-year checkup, do a post-transaction kind of an estimate. A lot of people work on that during the summer. It's a best practice.
Mark trying to keep all of our viewers from being part of the funky bunch out here. Mark Stieber, Jackson Hewitt, Chief Tax Officer. Thanks so much for the time and the tips as well.
Good to be here.
Absolutely. I'll toss things back on over to you, Rochelle.
All right, excellent stuff there from Brad Smith. All right, staying on the topic of tax, the silver lining of tax season, getting a nice chunk of change in your tax refund. But how do you get your hands on that refund in the first place? Here to break it down is Yahoo Finance's personal finance senior reporter, Rhonda Lee. Hey, Rhonda.
Hello there. So the first thing to remember is typically we have highs and lows when it comes to the tax season. So just like travel. So if you're filed early, you're in a regular low season. Right now, we're in the final stretch. It is peak filing season. So typically, if you e-file and get direct deposit, it takes about 2 weeks to get your tax return. If you did not e-file, or if you paper file, you have to deal with the IRS manually looking at your tax return. So paper filing is a delay. So if you are right now trying to file and you're considering e-filing, you need to understand that you're in peak season and there will be a delay of probably 21 days or so. The other thing is for taxpayers that had natural disasters like Alabama, California, Georgia, the April 18th deadline has been extended. So depending on the state that you're in, it's either May 15th, July 31st, or October 16th. The other thing that taxpayers want to consider is if you are below a certain income, typically $73,000 or less, that there are free filing options, either online software or through the Volunteer Income Tax Assistance Program that helps moderate to low income taxpayers file their tax returns.
So then, Rhonda, we'd like to think we're all responsible when we get our tax refunds, but some of us are about that YOLO life. What are we seeing as far as how people are using their tax refunds?
All right. So historically, low to moderate income families are using that money to pay off expenses. They're using it to pay their utility bills. A lot of people see it and they use it to buy groceries. So depending on your economic status, a lot of Americans are using it due to the inflation and all this other stuff. They're using it just to pay down debt. Now, if you have some financial cushion, those are the people that we are seeing that they're putting that money into a savings account. And if you really have cushion, they are going on vacation.
I like the sound of that. Ron DeLee there with all the great tips. Thank you so much. Right, well, data this morning showed inflation decelerated in March, but still remains high. And for the first time in 18 months, the annual increase in prices for food away from home topped inflation at retail food outlets. Prices at restaurants and workplace cafeterias rose 0.6% on the month. That's according to BLS. And this comes as a new report from William Blair shows that on average, consumers spent $188 at restaurants this month. For more on this report and dining trends, let's welcome in Sharon Zakfir, William Blair Equity Research Group Head of the Consumer Sector. Thank you for joining me this morning. So talk about some of the nuances that you're seeing in restaurant spending.
Sure. Well, so I think what we're seeing in restaurant spending is more typical seasonality, which we really haven't seen since 2018 and 2019. This is really the first year where we're kind of in a pandemic normal world. So when we look at restaurant sales and we see this deceleration in the March quarter versus December, that would harken back to normal seasonality, where consumers tend to spend a lot more during the holiday season. But then you see this ebbing off where the winter takes hold and people kind of sequester a little bit more and nest in their homes. So I think we're seeing very normal patterns. And when we look and we ask about year over year trends, we're actually seeing some encouraging patterns where consumers are basically saying they're eating out a little bit more in March year over year than they were in December. So it feels pretty good right now in the restaurant space as it relates to resiliency in the face of a lot of, macro headwinds and so on.
I mean, and I know that when we were coming off the back of the pandemic and people could finally get out and spend it in restaurants, we thought that a lot of the trends that we'd gotten used to, sort of just doing takeout or delivery, would sort of fall to the wayside. But some of the data showing that people are still taking out more than they are eating at restaurants. Talk about that trend and why that's still happening.
Yeah, it's really interesting. I think what we're seeing in the restaurants mirrors a lot of what we've seen in retail over the last 20 years, where convenience has become much more important. You can definitely see that in retail with the advent of e-commerce and the rise there. And consumers are very used to convenience now being part of the value equation. And that takes many forms. It takes the form of delivery. It's more, I think, taking the form of what I would call order ahead and pick up in store. And that's good for restaurants because that tends to be one of the highest margin channels in the restaurant space. So the more that, any of these restaurants can get you to order ahead and just come pick it up, that's a natural tailwind in the restaurant P&L.
And on the screen there, we have the Yahoo Finance poll that showed what people were cutting back on because of inflation, and eating out topped that list, very closely followed by shopping. Is that a trend you expect to continue? Is this going to be the new normal where we do see people cut back more on eating out for the longer term?
So it's interesting. Whenever we do a survey and ask, what are you going to cut back on? Eating out almost always tops the list. And then we see the results come in and they're very resilient from the restaurants. And I think, frankly, eating out is not necessarily as planned of a purchase as certainly buying a car or buying furniture or even buying clothes. People are going to make decisions multiple times a day about what they're going to eat and how they're going to get that food. And it's a real-time barometer of consumer confidence. I think people actually know with their stomachs, sometimes better than their heads, how they're feeling. And it's very encouraging, even in early results for the March quarter, that we're seeing kind of continued resiliency in how consumers are treating this eating out occasion. Also, don't forget, consumer mobility is very important here. So there's almost a natural hedge to some extent as more employers require their employees to come back into the office. That's a tailwind of the lunch business. So, I know there's a lot of concern, but there's still very resilient trends that we're seeing, and I think a lot of momentum in the restaurant space.
And we did see some restaurants raising prices, others vowing not to raise prices. But as you look at the picture, and especially based on the survey, who do you see as the restaurants that are really the big winners based on the research that you're seeing?
Yeah, I think there are some that you would expect, like a Kura Sushi, which, on average, they've got this great tech-enabled format. They're able to reinvest that into lower price points that are kind of half of what their peers are at, and they certainly see the traffic advantage there. They've just had a quarter that they reported that was very healthy. But one of the most reassuring data points we saw in our survey was with Chipotle. Chipotle is a concept that's taken a lot of price over the last 2 years. They've seen their restaurant level margins go up over the last 2 years. They talk about their value proposition still being very good and solid. And it's great to see in a survey like this, Chipotle be in the top 5 in terms of perceived value. That gives me more confidence in their ability to continue to sustain traffic gains, even with all of the price that they've taken.
Certainly an interesting picture as we see these shifting dynamics and keep entering into new phases of the new normal when it comes to restaurants. A big thank you for your insights, Sharon Zakfir, William Blair Equity Research Group Head of Consumer Sector. Thank you so much. All right, well, let's get you a final check of the markets as we head into the noon hour. As we saw, they've gone from a mixed picture to now in all 3 major indices in positive territory. The Dow, they're at least up about 80 points, they're about 0.2%. The S&P, they're also seeing gains there, edging into the green, up about 7 points. Just in the last few minutes, eking into positive territory. The Nasdaq there, seeing some daylight there, up about 5 points, 0.05% as we head into the noon hour. That'll do it for now. I'm Rochelle Acutho. I'll be back with you on Yahoo Finance tomorrow. See you then.